the faster, more productive AI and analytics platform that works across your entire company. Robust data prep, powerful advanced analytics, and streamlined model deployment. It's never been easier to turn 1 billion points of data into a point of view. And it's fast. Data engineers will help you access, manage, and govern your data so you know it's accurate, high quality, and ready for analysis. Data scientists build best-in-class AI models your way. Code in any language you'd like, or use drag-and-drop tools. Or sit back and let Vaya do the work for you. Business analysts, go beyond basic BI. Tell your data story to any audience. With Vaya's dynamic visualizations and automated insights, you'll uncover hidden value when it matters most. Machine learning engineers. Test, deploy, and manage all of your models, no matter the coding language. Vaya works with you to streamline the entire analytics lifecycle. Take faster, more productive AI and analytics from SAS for a spin and put your models to work.
Customers want decisions fast. You need them to be accurate. Delivering both requires reliable, timely insights. At a time when disruption is high, the future is unpredictable, and everything is digital. Organizations must make real-time risk decisions to approve loans in an instant. Otherwise, customers won't just be frustrated, they'll take their business elsewhere. It's time we reimagine how we make decisions. Welcome to redefined risk modeling and decision-making for a digital era. Taking loan requests from application.
Good afternoon to all. A warm welcome to second edition of Business Standards SAS event. This is a very special and topical event on the resilience of Indian banking system against the backdrop of what's happening in the US. 3 sessions this evening will focus on 3 critical aspects of banking. And of course, to set the context, we have a fireside chat with former RBI Governor N.S. Vishwanathan. May I request Shailesh Dhoval, Editor Business Standard, to come on the stage to formally welcome all. Shailesh. Thank you.
Thank you, Sangeeta. Good evening, ladies and gentlemen. I have the honor and pleasure to welcome former Reserve Bank of India Deputy Governor, Mr. N.S. Vishwanathan, as a chief guest at this special SAS Business Standard Risk and Banking Resilient event. The context in which we are holding this event is important and a bit sobering as well. Recently, we witnessed 4 to 5 bank failures in the US and Europe. What happened, and as one of Business Standards columnists aptly put it recently, and I quote, "The bank's management failed, the board of directors failed, the supervisors failed, regulations turned out to be inadequate, everything that could go wrong went wrong," unquote. So essentially, it was a perfect storm. And with over 600 billion in bond losses sitting on books of local mid-sized US banks, the crisis is far from over. In this context, there are questions being asked if market discipline by itself is enough to take care of financial sector stability. What is a better approach to safeguard financial sector stability? An intrusive approach, as RBI is often accused of adopting, or is light touch regulation a better option? Well, look out for answers to many such questions and concerns from a stellar panel that we have assembled this evening. But before we start the proceedings, a few words about our chief guest. Mr. Vishwanathan does not need any introduction at all to this audience, but please allow me to do it entirely for form's sake. Mr. Vishwanathan is currently the chairperson, College of Supervisors. The RBI set up the College of Supervisors to augment and reinforce supervisory skills among its regulatory and supervisory staff at entry level and on a continuous basis. Mr. Vishwanathan has around 4 decades experience as a central banker and an administrator. At RBI, he was instrumental in setting up the enforcement department and represented the regulator in numerous international and domestic committees, namely the Basel Committee on Banking Supervision, Financial Stability Board, International Credit Union Regulators Network, the Banks Board Bureau, Institute of Development and Research in Banking Technology, and many more. He was a non-executive member of Board of Directors at the Securities and Exchange Board of India, the Punjab and Sindh Bank, the Dena Bank, and the Punjab National Bank. We are very grateful, Mr. Vishwanathan, that you could spare time from your very busy schedule to be here with us. May I now invite my colleague, Mr. Tamal Bangodopadhyay, and Mr. Vishwanathan to please take the stage. Please. Thank you. Tamal requests you to please kickstart the freewheeling discussion on risk and banking resilience with Mr. Vishwanath. All yours, Tamal. Thank you.
Good afternoon and good evening or whatever. I mean, there is some people from other geographies watching live this. Mr. Vishwanathan, welcome. More than Deputy Governor, in your current role, the chairperson of the RBI College of Supervisors. I'll focus on that. The backdrop, as Sangeeta mentioned and Sailesh also talking about that, is what's happening in US. Is uncertain time. Now, in just 5 days in March, 3 banks collapsed in US. Which are the 3? There are small to medium-sized banks, starting with Silvergate, then Signature. Both of them had significant exposure to cryptocurrency. One is based in California, that's Silvergate, set up in 1988, IPO in 2019, just 3 years back, 4 years back. And then Signature is New York-based full-service bank. And in between, in March 10, we got the Silicon Valley Bank. That was bigger among the 3. And why did Silicon Valley Bank fail? That's not a new story. It's asset liability mismatch, which we'll discuss during the course of the day, the risk management and all. So it had money. There's not much of taker of the money, so it put in US bonds. And the bond yield rose, so that prices went down. And when so there was mark-to-market losses. I'm not explaining technicalities because the audience is very specialized audience. All of you appreciate that. So when there was a run on the banks, they didn't have many money in their coffers to support that. That's what it happened. And then as we speak, this month, one more bank got there. That's the First Republic Bank that also got into trouble. And in between, we had the Europe Credit Suisse. Of course, that's a scandal, cocktail of many things. So that's nothing to do with asset liability as such. But that's the backdrop. And fortunately, Mr. Vishwanathan would agree with me that we are not affected any of this. But I think we are, the memory of 2008 is still fresh, even though after 15 years. Even though at that time also the banking crisis did not spill over to Indian banks. It was more an economy related thing, other stuff and all. As far as Indian banks is concerned, we are quite good. I mean, this is too good to be true. The last quarter results of public sector banks, hold your breath. The net profit for the year, including the last quarter, crossed 1 trillion, first time ever. Our non-performing assets, which was 10% plus in 2016, I don't have the March figure, but December is, I'm talking about the gross non-performing assets, which is the second worst among the G20 nations in 2016. Now it's 4.5% in December. It should be even less by March. State Bank of India, country's largest bank, has less than 1% net non-performing assets. Banks are all well capitalized. So Health is pretty good, too good to be true. So uncertain time in US, partly in Europe, some pockets, but not in India. But if you look at the governor's statement, and it was done at a global conference of Bank of Supervisor, which is chaired by Mr. Vishwanathan. It was on April 27. It's put up on the RBI website yesterday, part of the May bulletin. Before coming here, I was going through. Now, it's repeatedly he's talking about that RBI is looking into even the business model of banks. So going beyond macro, it's now even the micro. How much is your deposits? What part is bulk deposit? How much is your loan? And what part is uncertain, unsecured credit? Everything is now on RBI glare. RBI is doing lots of things which is unheard of. Instead of me saying this, I think Mr. Vishwanathan, you will tell us in this time, banking sector resilience in uncertain times. But as I repeat, uncertain times is not in India, it's in US. We are pretty better off. In fact, as I said, too good to be true. So first question is, it's a freewheeling conversation for about 40 minutes. Sir, I mean, do we need to take cognizance of what's happening in US, and can it impact us?
So, thanks, first of all, for inviting me and allowing me to share some of my thoughts. Before I answer your question, I want to say that before this global financial crisis hit, banking system crisis hit in the US, or whatever we are reading now, the College of Supervisors, the Academic Council of which I chair, has been given a mandate. That's the theme of the global conference that we had. It's called Creating a Financial System that is Resilient, that is Future Ready, and Crisis Immune. So the task of the College of Supervisors is to enable the Reserve Bank supervisory and regulatory staff to create such a thing. And this was not coined after the crisis. This was coined almost 2 years ago when this college was set up. So that's the mandate the college has, number one. Number two is that, as you rightly said, even the 2008 financial crisis did not have an impact on the Indian banking system directly. It was more through the economy. So, because we didn't have any of the problems, particularly the liquidity risk issue, which was the problem there. Because two things. One, we already had an SLR. The global system thought of LCR much after. We had SLR, which is almost as good or even better than LCR, number one. Number two, even at that time, I'm saying, right, Mr. Ravi Dubir is also there. Even as inspector maybe about 25 years ago, we were told, you please look at whether the bank is dependent upon market borrowings. We used to frown upon a bank which is borrowing to meet its SLR CRR, even at a time when the SLR CRR together account for close to 60% of the deposit that was being raised. Okay, so there was a kind of what you call a concern right at that time for RBI to ensure that liquidity is not a problem. Because I keep saying this, in the banking system, the time for liquidity risk to become a solvency risk is very, very little. It's too quick that the liquidity risk move to solvency risk. And that in a way what you see, that's what happened in SBB crisis. The moment you have a liquidity risk, you have to borrow, you have to raise money at loss, right? That's what happened. So if you ask me, I don't think the financial system issues that are there in US will have any impact on the Indian banking system directly. And second, some of the idiosyncratic issues that we face, SVB for example, a few large depositors, okay, well-informed depositors who would run away with the money at the drop of a hat, so to say. Number one, poor management of interest. I mean, maybe we can call it in retrospect, but if you ask me, what should SBB have done? SBB, if it was getting deposit at that kind of a rate, by definition it had to only place money in long-term papers. And so they not only had an interest rate risk coming from the change in interest rate, but also duration risk. So if you look at the duration of Indian banks, government GSECs, it's not that way, it's a lot more spread as opposed to these guys. So I think I would say that even maybe it's part of our DNA, honestly speaking, that liquidity risk is something we don't let happen. and we must thank our legislators for foresight of that time, and that's still ingratiated into our DNA system is what I will say.
So, Mr. Vishwanathan, if somebody outsider sitting here, a few of them, you are saying that RBI is more proactive than many other central bankers.
Absolutely. I would say, I mean, I can tell you, let me tell you this, some of the things when we were doing, we were not even knowing what we were doing it for. Because we were so young, okay? But I can think of what people thought, and look at, I think it's for no reason, it's not for any, without reason that Dr. Stiglitz said that if there was a governor like Dr. Reddy, you wouldn't have US central bank crisis. And the reason for that is, we didn't know what we was doing. 2006, okay, before the crash, 2006-07, he increased the risk weight on exposure to real estate. Okay, he asked for a higher CRAR on 1% additional provisioning for standard assets and real estate exposures. 3, he put a limit on interbank borrowing vis-a-vis their overall capital. Actually, at that time, we were not even understanding what this was happening. But mind you, if we didn't have the crisis of the sort that we had, you have to actually look at some of these actions that were taken. And there's a beautiful speech which Dr. Reddy made after he retired in IMF, where he explained what went into his mind when he put all this in place.
Thanks, Mr. Vishwanathan, but still, I mean, no offense intended. We had Global Trust early this century.
Yes.
We had Yes Bank just few years back. Yes. So if I accept that you are so progressive and you are so, I would say that ahead of other central banks, but things do happen here also.
Well, yeah.
So tell us, let's not go back and what has gone wrong, but tell us the new regulatory landscape. But because the way you are looking at it is not the banks alone, on the banks, even at the borrower's health also you are checking. And also along with the bank, larger NBFCs already are treated on a par, almost on a par with the banks, but even other financial entities also. So it's a very composite outlook, I understand, that you have at the banking sector now, and you are actually monitoring things on a real-time basis. It's not, RBI officially is not saying this, but my understanding is after SVV, now banks have been asked to file data twice a day. You are keeping a heat map of each bank. If anything is going wrong, whether on the capital side or in terms of asset liability mismatches, just the red flag is there and all. Can you give us a sense, because they are all people from risk management, compliance, and Treasury. These are the, besides the technology, these are people. Can you give us a quick sense of what is the new regulatory landscape of RBI to prevent any kind of untoward incident?
Before that, I think since you mentioned a couple of cases, I must tell you, because I can't just not react to that.
Okay. My purpose is served.
Yeah. So two points. I think there is a difference between what happens as a systemic crisis, number one. You will have an idiosyncratic problem, number two. Third is the interventions did not take place after the problem. Let me be very clear. In all the cases, the interventions were made at the time the problem was seen. It was anticipated by RBI. Let me be very, very clear. Number two. Third, as far as the current landscape is concerned, I mean, I am not obviously aware of what is happening within RBI, but we realized 2-3 things which are very clear. Number one, the Reserve Bank today has a lot more of technological capabilities, both in terms of hardware and the kind of people that it has recruited, because large number of people have been recruited today at the grade B level are people with IT background. So their ability to understand, write SQL even on a program, that's very important. You will have data, you know what to query, right? So those capabilities those people have. And as far as I know, the Reserve Bank has the ability to look at what's happening in the bank on the basis of the information that it has on an ongoing basis, number one. Number two is that what it does with that, and that is where I think I have also understood that we need to kind of, there's no point in just gathering information unless you use it, and that is being done on a very, very real-time basis, because if you saw the speech of the governor at the global conference, he's definitely concerned, I would say, that the banking system should be resilient, and the RBI has been taking a series of measures to prevent any accidents, is what I would say. And as a part of that, obviously RBI had introduced risk-based supervision in the past, but the quality of information that RBI is collecting as part of that process has improved. Number one, ability to process that information has improved, and and also the kind of people we have to do that is also improved. That's well put.
I think it all started during Dr. Rajan's time in 2014. You put the Acrylic platform in place, right?
Yes.
Where the banks need to tell almost real time to RBI of any loan which was initially 5 crore, now it has come down, anything goes wrong. And this is not available to the outsiders, even to the rating agencies, correct?
No. It's a supervisory data, but it is available for viewing by a bank which has exposure to a particular borrower. Okay. So the point is, if a bank X has exposure to borrower X, borrower Y, any bank Y which has exposure to bank the same borrower, they can access it, number one. Otherwise, it is not possible for a bank to look at it.
Vishwan sir, just for academic interest, you said that whenever there is a problem, actually you start acting from day one. But we got to know it much later. Is it because the so-called financial sector stability that you don't want to disturb, that's why you do it quietly? Like for instance, Yes Bank work had started much earlier, but we got to know much later. Is that the way RBI's approach?
Because I think timing is very important. Timing of the action is very important in many of these things. So, people do say RBI was behind the curve or was late. It's for people to take a call on whether it was so or not. But what I can tell you is that it's not something that we weren't aware. And some of the actions started when the bank was reporting, and even assess capital was pretty high. And you refer to governor's speech where he talked of business model risk, right? And that's something that we anticipated in that case to kind of intervene early.
As we speak again, Mr. Viswanathan, RBI had just had the first meeting with the boards of public sector banks, and yet another meeting is slated for the next week with the private sector banks. Can you give an explanation what? You don't trust the board? You think that the so-called independent director are not so independent, and there's a quality is lacking, ethics, governance are issues with the boards of banks? Is that the general impression?
So I wouldn't know the insight, but I think
generally what's happening?
As I saw it, the reason for this is to sensitize the board, because a lot of issues are taking place in the banking system. And in some of the cases in the past, we found that the boards were saying that we were not aware this was happening. Okay, so I think when you have a larger financial system issues that are coming across the board, I think sensitizing the board members to be aware and alive to those problems, I think it's again a step of proactive nature, so that they are looking at issues from the perspective of risks that are emerging within India and outside that could spill over to the Indian banking system. So as I saw it, it was more to give the board members an idea of the risks that RBI is seeing in the system and sensitizing them to that direction.
Prima facie, it seems that the bankers have learned their lessons from that AQR asset quality review that RBI launched in 2016, that 6 quarters actually went into their kitchen and bedroom and found out what were the pile of bad assets below the pillow. And now perception among the analysts, in the analyst community, is this credit appraisal, monitoring, risk management, underwriting is far better than what it was. In between, actually bankers are not taking any decisions. 2019-20, I'm talking about pre-COVID. But now they are more confident, and that's what we are seeing, 15% odd credit growth, etc. So tell me, do you believe that things have changed in Indian banking in terms of underwriting, risk management, compliance? Is it better post AQR? Is it a new regime for Indian banking?
Yeah, 2 things. I think one, AQR facilitated RBI to understand how a borrower behaved across the banking system. So that was one. That was the Acrylic was a database which RBI could see above 5 crores exposure of banks across all borrowers, right? A single borrower and across our banking system. So that enabled us to do the AQR in the way we did, and looked at how a particular borrower was being treated by different banks at different points in time, number one. The second part is, in my understanding, the quality of assets is function of internal processes, number one, which a bank follows. Number 2 is also a function of credit culture. And credit culture influenced by many external factors. So, for example, in the retail segment, the improvements in the credit information system, where if there's a default, you get to know people, you get listed there. That improved overall repayment culture, number one. The CRILC and IBC, in my opinion, has also created a improved credit culture in the corporate segment, because it's very clear that one could lose their business if they don't run it well and become a defaulter. So I think there are both internal. Third is, I think today the IT information that banks have. So one of the things people ask is, this growth in, governor has also raised that issue, growth in unsecured advances is pretty high. Obviously the banks have to look at it very closely, but I would say if I had seen this 10 years ago, I'll be even more worried. I'm not saying I'm not worried, I'll be a lot worried 10 years ago. Why I'm saying this, today there's a lot more of information, the fintechs are able to source data and provide therefore a lot better appraisal of a potential borrower, number one. Third is, earlier I myself have spoken when I was Deputy Governor, don't join the retail segment banking bandwagon, because this bandwagon problem is a huge issue, right? And that is because some of you need to put systems in place, like the sourcing party should be different, the sanctioning party should be different, whether people who have gotten into the bandwagon have put all those things in place. So I think today, largely, I'm not saying that I'm endorsing the growth in unsecured credit, but I'm saying that I'll be lot more worried at this kind of growth 10 years ago. I'm still worried, but obviously relatively less than I would have 10 years ago.
You spoke about fintech, and led me to my next question, which I was planning to ask, because again in the governor's speech he spoke about the cyber risk, one of the top 10 risks globally. Now in Indian context, I would not name, but one particular bank was actually getting into retail through multiple cooperation arrangements with the digital players and all, and you came down heavily on that particular bank. So tell me how genuine, how real is the cyber risk here and this digital lending?
Yeah, I think we want to bifurcate into two segments. Number one, the one problem was use of fintechs to source business. Okay, and the problem that arose was, while the fintechs were supposed to be agents, okay, the fintechs almost became the lenders. So they became fronts, or the banks became back office for them in a way. So what we want to do is that, therefore they were in the unregulated space. So if somebody in the unregulated space is entering financial sector and blurring the line between banking business, or financial sector business and technology business, that's a worry for RBI, okay, which is why you saw the whole digital lending guidelines that have come, number one. The second is increase in reliance on technology for all purposes. Number one, data being everything in a system. Those have 2-3 elements that are raising. One, hackability, so the susceptibility of those information to get leaked, number one. Number two, frauds based on that, because there are various ways through which fraudsters are able to get into the system, and that is something to be stopped. So globally, in fact, it's come as one of the top risks for among the CEOs as per a survey that's been done, and RBI is placing a lot of emphasis on the quality of risk management surrounding their IT systems and cyberspace related activities to prevent their systems being compromised because of laxity in that area.
Sir, in the entire scheme of things, how do you see the role of the auditors?
Yeah. So
both internal and external. And just audience, if you have any specific question, no comment, just prepare your question. If time permitting, we'll take a couple of questions from the audience. So just get a microphone please for the audience. In the due course, it's still a little while away, but prepare yourself. If you have any question, just raise your hand, introduce yourself, and very brief question, no commentary. Sir.
See, fundamentally,
auditors.
In the system of risk management, okay, you have business, risk management and internal audit as the 3 layers of risk management, okay, and in the statutory audit relies on the internal audit, and the statutory audit is more a kind of confirmation to the public that the accounts have been prepared as per the standard practice required, okay. So for me, internal audit is an important element for risk management. It's a globally accepted thing. That is the 3rd layer, okay. And if that system is not working, you will have problems. And you can see wherever some of these any type of risks have materialized, it has happened because apart from business failing and the internal risk monitoring failing, the internal audit too has failed, either because it did not have the right mandate, or it did not look at the mandate properly itself, or third, the compliance based on the findings were very inadequately processed. So no two ways about it saying that internal audit in particular, because external audit is more for an external phase, okay, and that's what Reserve Bank relies on when it looks at the inspection process. But internal audit is extremely important for risk management. And if that is taken lightly, any system, whether it's bank or financial or any real economy entity as well, they are going for trouble.
Sir, one I would say perception or allegation, whatever you call it, is a question of semantic. The bankers in private say, we have a banking regulator, it's now into micromanagement. I mean, when globally we are talking about basically leave it to them and it's no more rule based, it's a principle based regulation. Actually you have reversed it. From principle based you have gone back to rule based, and you are just every breath you are counting with the stethoscope or the banks, and you are getting into micromanagement in private. In fact, this is a question we asked Governor also during the Business Standard annual financial conclave in December. He of course has his own logic. Entire banking system was sitting in front of that, and he had his own logic, and he of course said that I am provoking the community. So here there's only one or couple of CEOs are here, but there are also bankers, risk managers, treasury managers and all. In private, they will never tell you that because they're scared of you. But in private, when they're looking for shoulders which they can trust on, he said, "Tan aa gaya boss, see to RBI to had kar diya life ko micromanagement." How do you react to that?
Okay.
Just tell them, they are the audience.
Yeah. I'll tell you I think there's a difference between micromanagement and intrusive supervision. Let's be very clear. Sometimes I think the line which banks are drawing is on the wrong side. If you look at the global literature on supervision, the first, one of the characteristics of good supervision is that it must be intrusive.
Intrusive. It has to be intrusive. Okay.
And what it means is that the supervisor should not worry whether he is asking a question he shouldn't ask. If the supervisor believes that a particular information is required for the supervisor to come to a conclusion, that should not stop the supervisor from asking that question, number one. Okay. Number two is it's extremely difficult, because look, the supervisor has to come to a conclusion based on his findings on XYZ number of instances. So many of the conclusions are based on sample basis study of items that we would have looked at, number one. Number two, if that results in their finding some aspects that need further detailed study, they are asking for information, shouldn't be worried, number one. So I'll have to look at what you mean by micromanagement. Asking too many questions for me is not micromanagement, number one. Number two, let's be very clear that the debate on whether it is principle based or rule based supervision, the jury is still out. Okay, so both have their own pluses and minuses. But what is very important is in a principle based regulatory framework, the player should understand and go by the principles and not go by the letter. So you can't have a system of principle based regulation where people go by the letter when it comes to interpreting. So you must interpret the principle if you are doing principle based, but here that doesn't happen. So people, the issue that arises is, are we also ready? Are we ready for principle based regulation? Is the system ready for principle based regulation? Those are things that we need to. So I wouldn't say that there's and look, we are talking of this. You look at the US Federal Reserve regulation on credit cards. It's perhaps the most micromanaged regulation in the world. So it's not therefore unfashionable to be rule based where it comes. So the question is, in my opinion, the line between being micromanaging and being intrusive needs to be properly understood. And if they say you can't take 2 steps, no, you can only take 1 step, those might be, and that might also be coming because somebody took a second step without looking where the ladder is. Okay, that's a possibility. So it's come from experience. The point I'm trying to tell is we need to understand that. And my personal view, is that you would rather as a system benefit from a very proactive supervisor and regulator, because you see, accidents take place because police don't do their job. Okay, so let me be very clear. So you say that the police is regulating, it's a problem for me. So I think let's be very clear. So long as you believe that it is impacting how you want to do your business per se, okay, I wouldn't be worried about that.
Sir, that leads to the obvious next question, and I have only one more. So before that, we can take one or two questions from the audience. Is this RBI's own capacity building? Yeah. You did say about this, the Board of Supervisors, which RBI constituted much before this US banking crisis, and you anticipated, you were proactive and all. So that's only one part of it. But could you tell us that what are the other things need to be RBI needs to do? Like, is our regulators' understanding of the digitized banking is complete, or there are some gaps?
First time after being recruited, they are being given a very intense training, so that they don't feel ill at ease or in the sea when they go and actually do an inspection or supervision of a bank.
Yeah, you are also putting places in the right kind of infrastructure, like you have formalized the guidelines of that interest rate risk in banking book that you have done. Yeah. I think it's too premature, but you are also going for that expected credit loss ECL discussion paper.
This. If you remember, these were part of the Basel III framework,
yes,
which were all postponed by a year or two because of the pandemic. Globally, the Basel Committee advised all the central banks that they can push the implementation by a year or two. Correct. Because the pandemic was not the right time to put them in place. So now all central banks, RBI included, are working to implement. So there's a delay in implementation of the Basel III by about 2 years because of this pandemic, and the interest rate risk in banking book or market risk guidelines which have come is a
new RBI approach.
So I think
you just don't trust them. Is that correct?
No. So the point is very simple. I think you said that as well.
Yeah.
But what is too good is again a matter of one's judgment, right? Correct. But if it's too good, it is too good to be true, and therefore it is to be passed. So I'll put it that way. The question will be only whether RBI is assuming too good. What is normal as too good? That's a different issue. I can't say that because I don't know the context. But if it is too good to be true, I think I would rather the RBI calls it now than regrets.
Any question from the audience? Anything? No? Yeah, please. Just give it brief, and there are two questions here. I will quickly, first one and then this, because time is a factor, and then I'll just end up.
Sir, Damodaran from Federal Bank. We are going to implement IRRBB. The timelines for implementation only is to be announced. The methodology, everything is ready. But shall I a little bit
quickly, sir,
know the answer?
Yeah.
When banks are required to link more than around 50% of their loans and advances to an external benchmark, would it not actually, as pointed out, it will be a micro kind of management, inducing a huge interest rate risk in the books of the bank?
Yeah. So I think you're talking of the external benchmark related rate, right? So it's an IRRB related, but has happened 3 years ago, right? So fundamentally, if you look at what we found in RBI, is that RBI tried to move towards a system of regulation where the market tries to capture the signals and work on it. Okay, which is why. But what we found was that it was not actually transmitting. The interest rate changes in the monetary policy were not transmitting to the interest rates both ways. Okay, but of course it was upwards was a little faster as opposed to downwards. Number one. Two, which is why RBI toyed with various kinds of. We had the base rate, then we had the prime lending rate, and then we have the marginal cost based lending rate. We found that in all cases where the benchmark, whatever benchmark is endogenous to the bank, internal to the bank, there were a lot of opportunities and options, irrespective of however tight we made the regulation, there were possibilities for those to be kind of what you call on the borderline. Which is why we said that at least for the smaller borrowers, for whom the transmittal of the monetary policy changes have to be very visible and clear, there must be an external benchmark which the bank can choose, whatever it is. Okay, and one thing which we said is you can choose any margin over the benchmark. That's not left. What we said up in that regulation is that once there's an external benchmark, you marked it up, then the markup cannot change unless there's a change in the credit quality of the borrower. Okay, that's or business policy risk. Okay, so the point I'm saying is, at that time people asked me the same question. I did a what do you call a town hall kind of thing when we put out that external benchmark rating. For me, the only way you look at it is we must develop a robust interest rate derivatives product. Let's be very clear. There's no point in honestly to say that this is a problem we can't solve. It's not insolvable. We have a problem in the form of transmission not happening. So this solution has been found, and I would say that this should actually result in, instead of people saying how do I deal with it, it should actually result in a more robust interest rate risk derivative market in India.
For the record, the entire MSME segment is now EBLR linked. Entire MSME. And overall,
and the retail, of course.
It could be about 45% of the loan now MSME. Yeah, this gentleman there at the end. Can you just quickly have it, and then we'll round up with the last question. Yeah, please.
Hi sir, my name is Pulkit. I'm from SAS.
You are not audible. Just put the mic on, please, or give him the right microphone.
Hello.
Yeah, please.
Hi sir, my name is Pulkit. I'm from SAS. So my question is, RBI launched Daksh last year, Subtech initiative, right? What are the prerequisites or what the bank should be prepared of to successful, so that the Daksh as an initiative should be completely successful?
I'm not very familiar with this. What is that actually?
So RBI launched Daksh.
What is that? I'm sorry.
Daksh is a Subtech initiative launched for supervisory monitoring, right? Last year. Okay. So what should the banks be prepared, not only from a tech front, but also from a data perspective, so that the initiative, which is Daksh, is actually successful entirely?
So the way I look at it is are two things. One, the data quality. So the most important thing when anything is based on data is the quality of the data per se, right? So what I'm sure that when RBI brought in the risk-based supervision, there were a lot of data cleaning that we were doing. So internal inconsistencies were being addressed. Two, therefore, I think if you ask me in terms of what banks should do, you must have a very robust database which is live and up to date and correct on an ongoing basis. And there must be a process of cleaning the data on an ongoing basis so that the information that you're providing to RBI is correct, and they take the decision based on that, right? So the quality of information for me is the most important element in this. Sorry, I was not familiar with the terminology, so I couldn't place it immediately.
This answers the last question. Yeah. If you look at the last quarter, March quarter results, entire banking system, I think barring one, every bank has announced their result. So it's excellent time, as I said, it's the best ever. And not only for the top line, and not only for the bottom line, look at the top line, look at the capital adequacy ratio, look at the gross and net NPS, look at the PCR, the so-called provision coverage ratios. On every parameter, Indian Bank is, it's something, it's unbelievably good. Now, tell me, will this run continue, or are there any pockets of concerns as a regulator you see? Because whenever we see that everything is fine, going fine, and everybody is bullish, then only we find that the cycle changes. So is the cycle too short a cycle, and we should be prepared for certain things, or you think that no, runway is ready now, we are ready to take off, and this 5 trillion economy and everything will fall in place?
So
that's the last question, sir.
Yeah, I'll put it this way. Number one, it's nice that the banking system is in the kind of health it is. The numbers are depicting, number one. Number two is that maybe in a way to rephrase your question, is it again a case of too good to be true and sustainable? Okay, one way to put that question. And I would say that it's little early to call it as too good to be true, because I thought it was too bad in the past. So I think if we are moving from too bad to normal, is what I see, number one. But this has not happened through magic. This has happened not overnight. It has happened through certain very, very clear actions. And I want to mention 3-4 of them. Number one, I would say the AQR was one of the most seminal steps that RBI took in identifying this problem. Number two is that the whole IBC process and some of the larger borrowers being taken to the system and losing their organizations themselves to others is another important example. So I will say that third, RBI has been always wanting banks to keep on building profits. So look at what one of the reasons why this has happened is, one, NPAs have come down, two, provisions for NPAs have come down, and the banks are running close to 70 to 80% PCR, provision coverage ratio. Okay, and the fourth thing, again, what RBI did, I will put it as, is for no reason that RBI put 6-7 banks under prompt corrective action framework.
11 public sector banks, overall 12.
Later.
Yes.
Okay. So for a long period of 7 of them were there. Okay. So what I'm saying is, all these things do imbibe a sense of caution in the banks. And so if people ask me, I used to say, externally a lot of things have happened which have improved the credit culture, number one. Internally a lot of things banks have put in place, but sustainability of this is linked to how those internal systems continue to be robust. And this, optimism does not turn into, irrational exuberance. So that's what I would put it as.
So with that note, sustainability, that's the key thing. We are in pretty good health, but how do we sustain it? We have just on time, so I don't want to continue anymore. We could have gone on and on till midnight with Mr. Vishwanathan around, but we have the rest of it, and then you have your cocktails and dinner. So give him a big hand, please, if you enjoyed. Thank you. Thank you.
Just. Thank you, Mr. Vishwanathan and Tamal, for this very high quality and enriching discussion. There are many, many takeaways, I'm sure, with this audience. For me, the way Mr. Vishwanathan explained how regulatory initiatives like AQR, IBC build up a virtuous cycle for the whole banking system in India, where, Tamal says it's too good to be true. Hope we are not proven prescient there. The problem of the principal and agent with banks and fintechs and how that definition needs to be understood properly. Mr. Vishwanathan raised the issue about internal audit being extremely important and how the lines between intrusive supervision versus micromanagement needs to be understood properly. And how, not just for the College of Supervision, but for the entire financial industry, how we need to understand the sources of risk keep changing and how do we unravel the unknown. I'm sure this audience has many more takeaways, but thanks so much, Mr. Vishwanathan, and thanks, Tamal, for a very high-quality discussion. Thank you. And I'm happy to share that Mr. Vishwanathan has kindly agreed to be with us for some time for the panel discussion as well. Thank you so much. May I now invite Mr. Anselmo Marmonti, Senior Director, Global Head of Risk Business Consulting, SAS, for a small presentation. Please, Mr. Marmonti.
Can you hear me? Yeah. Hi everyone. I'm very honored to be here today. I'm Anselmo Marmonti, and I'm Global Head of Risk and Finance Advisory for SAS. And again, together with my team, I'm supporting banks around the world and supervisors around the world. So I've listened very carefully what the previous interview with quite many interesting points. During these next 15 minutes, I will try to share our vision on some of the lessons learned around the world. I will start saying that not everywhere let's say the situation is probably as good as here. But on the other side, I believe that there are quite many lessons learned that we would like to share, both on the evolution of the main challenges and main drivers, and what are the impacts, especially for the risk and finance management, and obviously as a SaaS on the risk systems. It will be not technical, but really mostly on what are the challenges that we see and what are the areas of main focus. And again, as a SaaS, how we can work with our customers to really allow them to be resilient in this changing world. So let's start from the beginning. I will not go too much into the details, but as you can see in the slide, basically the main drivers for us are around the world, starting from the COVID-19, geopolitical tensions, ESG, and macroeconomic factors. Now, why all these elements? Many of them are not new, but in many geographies around the world, the impacts of these evolutions have not been yet solved. So COVID-19, of course, as we have seen, there are quite many disruptions in the overall supply chain, impacting, again, in many cases on cost and also on the, let's say, the resilience of the customers, the final customers of the banks. So in many cases, due to the fact that this world is heavily interconnected, even if in a territory the supply chain has not been impacted, the fact is that many customers of banks they have international business, so they can be impacted from other territories. And in this direction, the issue is that, again, for 2 years, basically, all the data have been somehow supported from the stimulus from the government. So all the models that we were used to use in the past, I would say that are not more valuable. They are not more predictive, and the experience is showing this. Geopolitical, without going into the details, but we know perfectly that, especially in Europe, all the tensions that we have seen have generated a strong increase in prices, energy, and this has obviously impacted the inflation and then the interest rates. So there is a strong interconnection also in that case, and again, this is something that generated a lot of issues. ESG is a key topic, we know. In some territories it's a priority, in many others it's not. But the fact is that many banks are anyway trying to incorporate in their business processes the effect of ESG. Last point on microeconomics. As I was mentioning, impacts on inflation, impacts on interest rate. In general, in many geographies, we see that, again, the level of stimulus that the central banks have provided to the countries is at the maximum. So the expectation obviously is that this will stop, and the credit cycle that it was extremely stable and positive in the past years, it will not be in the same situation. So the expectation I was at a global conference back in November, but also the one that happened in New York last week. The expectation is that in the next 6-18 months, there will be a strong deterioration of the credit quality, both for corporate and SMEs. This will generate strong pressure on the liquidity. We have heard that this is not a problem here, but let me just, again, also leveraging, as I was saying, the experience in US, some of the key impacts. This is just to give you a flavor on how Europe, for example, sees the crisis. This is a study done from the European Parliament. And again, without going into detail, in this diagram, you see on one end inflation and war in Ukraine. Then in the blue, what are the main impacts? So liquidity risk, interest rate risk on banking book, the spread risk on sovereign bonds, increase in credit risk, and again, all these will impact basically the drop in the bank's net value and the pressure on the capital. Somehow, all these drivers generated the default in Silicon Valley Bank. Now, the point from my perspective is, again, obviously there are regulations, there are systems, but the key issue is how to integrate all these regulations and systems in the real business of the bank. Because it's not just a matter of having a system or have the proper models, but really how to drive the bank, the business, and the decisions, leveraging these the regulations and the models and the systems that are available. Meaning that in many cases, what we're seeing is that it's somehow easier to just click the check the box and be compliant, but don't change anything in the business, in how we lead the business, how we manage the business in the bank. So at the end of the story, it's all nice. We have some additional KPIs, but at the end of the story, we don't have any change in how the bank is conducting the business. Reading the guidelines from RBI, from both IRRBB and also for ECL, I think that is extremely well described how these things, for example, IRBB, it's not just a way to calculate some additional KPIs, but this is the prerequisite for the issuing of a new product. It's a prerequisite to check how the bank can hedge the risk before launching a new product. It should be included in the ICAP process. It should be included in the stress testing framework. So it means that it's not just a compliancy. It's a way to change the process and the practice to conduct the business. Now, the point here is more and more critical because all the changes that are happening simultaneously create a greater interdependencies that we were not used to, and we were not used to that before, meaning that we were working by silos. So we had our nice RWA system, we had our nice market risk system, operational risk, all good. But the fact is that now everything is changing and it's changing simultaneously and the interconnections are many. So the point for me is that, or again, there is an evolution and there is the capacity from the intent and the commitment from the bank to evaluate in an interconnected way the different silos, removing the barriers and allowing to share data, models, engines across the different silos. Otherwise, this will remain somehow an exercise, not really a way to conduct differently the business. And this can become extremely dangerous because, again, also the correlation among the risk factors are changing. So we need to recalibrate the correlation, and they are changing much faster than in the past. Another aspect that is extremely critical is the behavior of our customer. Again, it's changed and it will change. It has been, we have seen with SFBB, right? So how fast the behavior changed. 2 tweets on Friday and the bank defaulted 3 days later. So it's extremely, extremely fast. And I understand that this is extremely good, but the point is the world is heavily interconnected. So from our perspective then, the point is how to be able to support banks in this process. And as I was saying, behavioral changes are extremely relevant. There are new data. The data and the models that we had in the past are not updated because somehow they have been, the predictiveness of that data are basically strongly influenced from the policies that the government put in place in the past. So the fact is that we need to recalibrate these models. We need to review the credit cycle because, again, there will be deterioration, as I was mentioning before. And in general, there is an expectation that, at least in the Western countries, many companies will fail, will default. Now, what it means we are a software house. So what is our challenge? What is our vision? Where we are investing? The point for us is, first of all, integration. So being able to orchestrate across risk the existing systems, but especially be able to put interconnections between these systems. Obviously, the goal for us is allowing to have a full integrated balance sheet view. That is exactly what we are already doing with many customers, even here in Asia Pacific. Then, on the other side, we want to also evolve the loan life cycle. Meaning, in many cases, we are used in the banks to focus the attention on the origination side, in the early warning, in the collection. But at the end of the story, we're talking about one loan. The fact is that we need to have the possibility to follow our customer since the beginning for all the life cycle of that specific loan. But how you can do it is not that you cannot do it. Probably you are already doing it. But the game for us is, due to the high volatility that there is in the market, especially, for example, on the calculation, we want to allow our customers, the business users of our customers, to configure and run simulations independently from the IT. We cannot count anymore on the IT, and because the IT has a lot of priorities, while the on-demand valuations cannot be handled with the support on the IT. We know perfectly, I mean, if we want an intraday simulation, we need to be independent to do it. And the fact is that you cannot build from scratch. It's true that there are people with the right IT background, but all the intellectual property that you need to run an NII calculation on an IRBB or ECL, do you want really to start from scratch? I don't believe that, again, is from a total cost of ownership the right approach. Because it's not the first project, but it's all the evolutions that you will have in the following years that will kill, from a cost perspective, that type of approach. And this is exactly what we are seeing. Many banks tried. Yes, first year good, second year they started evaluating a replacement. And this is the point, meaning allowing the business users to be autonomous, running calculation, simulation, configure stress testing, and see what are the impacts to support both the ask from risk management and from the CFO. An additional point, transparency. Transparency is, again, a key aspect because anyway, all these elements we were talking before about auditors. The point is that all these models, all these calculations have the direct impacts on the balance sheet. They have direct impact and they are supervised. So the point is how to guarantee that the business users have the right understanding of their models, not a black box, because black box is no more adequate in this time. Things are changing too fast and business need to understand exactly how things are evolving. So in this direction, I don't know if you have heard, but we have recently done, last July, the acquisition of Kamakura. Kamakura Corporation, leading company, specifically on the financial risk. Maybe you know that as a SAS, we are quite well recognized on the credit risk, ECL, regulatory calculations, internal rating. We have complemented it for what? For a full picture, integrated balance sheet management, so allowing to have a stronger management of the interconnection between what we have in the credit risk side, in the ALM, in the liquidity, in the market risk. So this is our view, and this is how we are moving forward. So again, one of the nice aspects, and is quite innovative for us, is that the acquisition of Kamakura has been total, meaning all the intellectual property, all the, let's say, software, but also all the resources are now our colleagues. Why I'm mentioning this? Two of them, for example, I don't know if you have studied quantitative finance at the university, but maybe you remember the Jarrow-Merton model or the Jarrow-Thurmol model. Professor Robert Jarrow is now in our organization, so leading all the quantitative research together with Don van de Venter, the founder of Kamakura. And they have customers between banks and supervisors, leveraging system, as I was saying, for market risk, ALM, liquidity, but also for a data service provider on all the implied ratings for example, the listed companies or the sovereign. Last slide before leaving to the next panels, where somehow we will deep dive some of these aspects. So, as I was saying, what is then our view? One modular solution allowing the bank to handle all the aspects across risk and finance, starting from a smart way to handle data. So don't go for a big data warehouse. For example, we were mentioning ECL before. Fantastic topic. We have 200 plus customers globally. Don't go for a large data warehouse. Go smart. Go focus on what you need. And again, the good point is that somehow the delay that you have, for example, for ECL or for RBI, allow you to leverage the lesson learned globally. And the point for us then, go straight, go on what is really needed, because again, this will allow you to have quick wins soon. And the point is for us then, a single layer for all the data governance, data management, data quality, as we were mentioning before, credit scoring solution, and all the origination phase. I9, CECL is the US version of it. All the regulatory capital calculation and simulation, ALM liquidity and market risk are really the areas where we'll have the contribution from the Kamakura, and obviously ESG and all the scenario analysis and stress testing. The point for us is all these type of layers need to be designed to be high performance, to support all the regulatory requirements, but especially to support you leading the business in a risk-adjusted way to support both the risk management analysis, but also the CFO analysis, like all the budgeting exercises, the planning exercises, and all the simulations that are needed. I would pause here. There will be the panels after my speech, so we'll have the opportunity to go deeper in some of these topics. Obviously, I'm open to have, if there are any questions, I can answer now or later. Thank you.
Many thanks, Mr. Momonti, for a brilliant presentation. I'm sure this audience has taken away lots of takeaways. Just give us 2 minutes to arrange for the panel, the first panel. Yeah, we'll be back in a minute or so.
Hello.
May I request everyone to assemble back, please? We are about to start panel 1. Yeah, okay. So, ladies and gentlemen, we'll kick off our panel 1, Meltdown sans Liquidity, the lessons from the US banking crisis. May I now invite the panelists on the stage. Mr. Damodaran C., Senior Vice President and Chief Risk Officer, Federal Bank. Mr. Biju EP, Chief Risk Officer, South Indian Bank. Mr. Alok Gupta, Head Risk Management, IndusInd Bank. Mr. B.S. Venkatesha, Deputy MD, NABFED and ex-CRO, Union Bank of India. Mr. Mahesh Kutti, Deputy Risk Officer, DCB Bank. Ms. Akriti Vyas, Liquidity, Treasury and Stress Testing Lead, EY India. And Mr. Wilson Yap, Director and Head of Risk Banking Solutions Asia, SAS. Please, and to kick off the panel discussion, may I invite my colleague, Tamal Bandyopadhyay, please. Yeah. Tamal, please. Another request for guests to please come back to the...
Yeah, those who are standing, if you don't mind, can you just take your seats? We'll just 30 seconds we'll wait and then let everybody settle down. That's the problem if you keep the tea counter open, then. So let's not have the wine counter open before the before we end. Otherwise, the entire hall will be empty. Yeah. Very warm welcome to the first session, and thank you, Mr. Viswanathan, for staying back. So they will be encouraged to speak frankly, passing on their views to the regulator. Even though you are ex-regulator, but still you are part of RBI by being the chairperson of College of Supervisors. So let me start with a little story or joke, whatever you call it. I don't know how far this is true, but this is about 2008. I'm sure all of you, or most of you, have heard of a gentleman called Jacob Frenkel. He was the vice chairman of AIG in 2008. You know, the collapse of American insurance giant, American Insurance Group, which was 1 trillion prior to the crisis, and then it lost 99.8 trillion, and then on September 16, 2008, Federal Reserve stepped in. That's how it was saved. Federal Reserve pumped in 85 billion. Now, what has Jacob Frenkel said is this. I don't need to tell you how to read a balance sheet, which side is assets and which side is liquidity, which side is liability. Quote unquote, you go to the internet, you will get this. It says that he said that the left side of the balance sheet has nothing right, and right side of the balance sheet has nothing left. I'm repeating, the left side of the balance sheet has nothing right, and the right side of the balance sheet has nothing left. But they're equal to each other. So, accounting wise, we are fine. And you know what happened to AIG. So, this gentleman here is a star-studded show, I would say. They know that you can be accounting wise, you're fine, but what can happen to you? AIG out of 1 billion, out of 1 trillion, 99.8 billion evaporated overnight. So with that note, let's start this 45 minutes. We have 7 of us, including me, 8. So I have a quick little discussions. We have already set the context, so I'll not waste take your time again explaining everything, because the fireside chat with Mr. Vishwanathan has set the context. We were talking about what happened in March and even in May in American bank, the liquidity issue. India is a very different story. There is no liquidity problem. Of course, bankers do talk about liquidity tightness at this point of time. As we speak, the overnight call money rate is marginally higher than the repo rate, so banks are complaining. But what has happened in the past 1 year, we have seen that, and we'll start with that. The deposit growth is far lower than the credit growth. As we speak, I have got the May 5 Reserve Bank of India number. Year-on-year credit growth is 15.5%. Comparative growth on deposit is 10.4%. In absolute term also, if you see, credit growth is 18.64 trillion. Deposit growth is less, 17.39 trillion. The difference was much higher, but it's catching up. Those who have come from other parts of India for this program, you must have seen from the airport coming to Bandra on the highway, you count the number of bank hoardings offering the rates and wooing you. I mean, I have never seen that, and bankers also say that they have never seen this kind of fight for deposits. There is no asset liability mismatch as such, because if you ask the bankers, they will say no, we'll manage because we have enough government bond holding, the so-called SLR, excess SLR, and we can always liquidate and generate liquidity. But practically, it's not done because you have 15 trillion plus gross borrowing program staring at you. So we don't have any liquidity crisis, but we have liquidity crunch. And that's the macro story of Indian Bank at this point of time. Ideally, I should start with the lady, but I am keeping you a little later. But start with Alok now. Just give us a sense that, is it like, are we making it too much, or is this a problem in terms of when it comes to deposits? Because the panel is all about ALM. Asset liability, meltdown, sans liquidity, lessons from the US banking crisis. Yeah, quick.
Right. So, good evening, everyone. So I'll just take this from Mr. Tamal. Yeah. So as you rightly said, in the past few years, if you see, the credit growth has been much faster than the deposit growth, and while there is a liquidity in the system, if you look at the LCR and the other frameworks with the banks, which measures the liquidity in the system, everybody is flushed with liquidity. In fact, there is no liquidity crisis as such. But yeah, what counter is a credible liquidity or durable liquidity, right? Is on the deposit side, what constitutes the liquidity. So there is a race for deposits, the much granular deposits. That's more a retail and small business customer, which is considered to be more durable in terms of liquidity, and that remains stickier in terms of crisis in any crisis. What we have seen in SVB also, because the kind of liquidity, kind of depositors, because of the Reliance is not bulky depositor. In case of stress, you will find the sudden outflows, and which difficult to counter that. And then you have to liquidate your investments, and depends on what kind of investments you make. And what we have seen SVP, there's a complete erosion on the asset side, on the market value of the asset side. So it's a liquidity. What's the kind of liquidity? So banks are going for retail small deposits, and that's why you're seeing some sort of raise in terms of rates. That's what you're seeing, such kind of holdings. Yeah. So, and the credit season has been good, and I think the deposits still are lagging behind.
Alok represents a pretty large bank, IndusInd Bank. So let's hear a relatively smaller bank, that's Biju sitting next to him. He is the Chief Risk Officer of South Indian Bank.
Thank you, Tamal.
This is just a preliminary comments, then we'll get deeper into this.
Yeah, I agree with what Alok told. See, during the COVID period, there were not much lending opportunity, and banks were awash with the liquidity. So if you see the LCR or other liquidity ratios, it was very evident actually. Even from a credit deposit ratio perspective also, Indian banks very much comfortable, and of course they're putting money in the government security market. And during the last year, when the repo rate started reversing from last May onwards, things are slightly changing. But then in the initial part of the last year, again, because of the already the stock we had of higher liquidity, the deposit canvassing thrust actually, it was pushed to the next half year. And as again, Tamal was telling about the hoardings in the highway. So now banks are full fund on deposit, full hung on the deposit rising. Of course, they might have the whatever happened in SVB or elsewhere. That also might be in the mind when we are getting a lot of durable liquidity. And another thing I noticed actually, maybe 25 years back, when banks were looking for a lot of retail deposit, that time banks were targeting very short-term deposit, like 15-day, 30-day deposit. Now banks are not looking for such kind of deposit. They are wanting a stable kind of deposit, which can support them in their liquidity for a reasonable time. And in the meantime, they are granularizing their asset side also, because of course there is a pitfall also over there. But then now what we are seeing actually, they are granularizing the asset side by focusing more on the retail and the small size of MSME also. So that also is happening during this period. So those are the takeaway I take from that.
Yeah, Mr. Damodaran, he represents Federal Bank. So how do you see, actually the other way of looking at it, if you look at the depositor, they said you actually exploited them far too long. You are too stingy. And now actually they are pretty happy that they are getting their pound of flesh. You have no choice but to pay them. I mean, is this the way banking forward in terms of asset liability mismatch, that you have to pay them more? So long you are just ignoring, you are taking them for granted. So if you see the Indian banking system, barring probably 1 or 2 or 3 banks, liability was just given. No, you always chase assets. Liability were given. In fact, I'm not talking about your bank, we're talking about the industry. In fact, if I am a depositor and if I'm going into there, I've been asked, why are you putting in money in bank deposits? You put it money in XYZ, some mutual fund or insurance and all. So the idea was, here is liquidity forever. Let's have some fee income rather diverting the liquidity into other spaces. And then all your chasing was assets. But now this matrix has changed. There's a paradigm shift in Indian banking for the past 1 year at least. It's not the assets, more than the assets is the liquidity that is a prime concern. Is that correct way of looking at it?
I would beg to differ on some counts and agree on some counts.
Please, that's why we're discussing. Yeah.
My difference is on the side that banks had ditched the depositors at some point of time. I beg to differ on that, because even if you see, when the interest rates during the COVID period was rock bottom, banks were paying something decent to depositors. It may not be of the handle that we are seeing right now, but still, yes, wholesale deposits, yes, banks might have ditched, no doubt at all, but retail still may be at loss, because if you see the deployment happening on the other side, it may be even attracting negative NII for the bank. If you look at the rate you are paying to your depositors at some point of time during that COVID period, and the rate you get on some of the corporate loans, which was running very, very near to repo, if not at repo. At that point of time, 4%. But yes, you are not giving the rate, you are supposed to keep that in check. That was done. I always used to tell my branches, my people, that you should be like water. In the sense that whatever you need to push at given point of time, you push that. At, as you rightly pointed out, when CD ratio was in 70 handles, or some banks even 60 handles, there is some reason for pushing for credit. But now it is other way around. CD ratio is heating up, hence you need to pitch more for deposits. I'm not going on to the other side, but one thing is there, over a period of years, our depositors also are well educated, and they have a lot of investment avenues, which as you pointed out, maybe bankers might only have taught them, agree, but they have a lot of avenues and they know very well where they have returns. So that is what we are facing right now.
Thanks, Mahesh. I made a mistake. I introduced him as Federal Bank. He's actually DCB. My apology for that. No, apart from those billboards that we see, actually we had seen bankers are hawking for deposits. Canara Bank, we found in Goregaon, somebody was asking for deposit. That's all also happened. And till recently, I'm talking about 2 years back, used to see that under the RBI norm, banks have to display what is the deposit rates. You need to go with a magnifying glass. Where is this little poster is there? Because they're so embarrassingly low, they were just hiding it somewhere. And now you get into a bank branch, is always in a big things, and how much you are paying, 8.15 or 8.5, etc., etc. Let's heard Venkatesha. He has an interesting background because he is coming from a large public sector bank, Union Bank, and now he is the DMD of NAFED, which is the infrastructure financing company, first of its kind in India. Not first, we tried with IDFC in the 97, that did not work out, but NAFED is a new one. So you are in a better position to tell us about the entire asset liability system, what's happening.
Yeah. Thank you, Mr.
Both in terms of maturity as well as absolute asset liability.
So when it comes to looking at the ALM aspect from the NAFED's point of view, when we are part of the Union Bank as a commercial institution, so we are part of the whole system, so it was very difficult to detect what exactly is happening. But when I come and see here, because my main source is the market, where all my resources, since I'm not allowed to take the customer deposits, where I need to look at the market. So in the initial days of this financial year, yes, it was really a very bad position for raising long-term resources because the rates were very on the higher side, so it was not conducive for issuing any kind of bonds. But now when I look at it, so with the liquidity easing out and the position has again reversed because the threat of interest increase because of the inflation itself was creating huge mismatch in the interest rates. So as a result, the bonds were shown a lot of increase in the yields, which are really deterrent for any long-term player to mobilize deposit and issue bonds and mobilize resources. But now when I look at it, the position has really conducive, and now the issuances have already started. So for the bond market, especially for the long term, absolutely no issue with regard to mobilizing resources. There is a good appetite, and there is a big vacuum because of the HDFC and HDFC Bank merger. So there is a huge vacuum which is getting created. Probably NAFED will be filling that space, looking at the plans we have for long-term lending. So considering that for issuance of bonds, absolutely no issue. So we are quite comfortable, and our assessments are saying that it is very conducive. When it comes to the deposits for the banks, definitely the situation has gone back to the COVID situation, so pre-COVID situations. If you see, the repo rate has come back. The liquidity, which was as surplus as 6 lakh plus in the system, has come down to 50 plus, small induced liquidity which is there in the system. So considering these aspects, the position is not that bad, but we are just gone back to the pre-COVID level. That's all I can say. So the focus was surplus liquidity, how to manage it. Instead of putting in reverse repo, we are giving it a throwaway price for the top corporates. So all those situations have now slowly reversing. So now still I feel the banks have lost the muscle power to command the price which they should command for the assets which they are building. So that long-term pricing, especially for even BBB, are commanding sub 8 or sub 8.5 when the GSEC rates itself is on the higher side. So that is where I think banks now have to really turn their table and look at pricing at the right side. Right pricing for the assets. That will definitely help in right pricing of the deposits also.
Mahesh?
Definitely there is a, as Alok was telling, that there is a shift in the way, the shift in the way the customer preference over the bank deposit. That is one aspect of the current problem in the deposit growth. And there was also base effect also working on that, during COVID period we were flushed with fund and advances were not working. But having said all, now if you look at the growth per se, the granular deposits are coming up, and we are seeing traction in the deposit with the rate of interest inching up. So don't see any systemic issue per se from the deposit growth side. That's what when we, on an ongoing basis, when we see the deposit growth.
Yeah. So there are 5 bankers. They spoke about that. We will go back to them about the lessons learned from what happened in US. But Wilson from SAS and Akriti. So we'll not ask you what we ask. We'll ask the bankers. So Wilson, tell me, because SAS, considering your background, I would ask you just essentially in this role of technology in the evolving asset liability management. How do you see that, particularly in a geography like India? I mean, when it comes to the payment system, we are in the forefront. I mean, we are much ahead even most of the developed markets. But overall, how do you see the role of technology in the ALM asset liability management?
Sorry, can you hear me?
Yeah.
We are in the midst of a banking crisis, right?
Not in India.
Not in India, yes.
Yeah.
On the other side of the ocean.
Yeah.
So every time when there's a banking crisis, just like the last one, we have a lot of questions or requests for proposal. Not just to ask us, I mean, as a solution providers, what are the things we can do to help the banks?
Yeah.
And one of the recurring for ALM space is the need for speed. If you think about it, if you put this into context, SVB failed in 48 hours, right? How long do you think your ALM solution should run?
Absolutely.
So a lot of this is about process, how fast it can go. With modern technology, for example, using grid computing, using cloud computing, it can split the processing down into very, very fast. Like for example, for us, our customers typically, for the ALM daily reports, they can get it by 9 o'clock every day through technology, using grid processing and using cloud processing. The second thing that we see, that often asked, is we see a trend whereby the ALM system is taken away from the business side. It becomes an IT project. It gets locked up. It takes time for an analyst to run any kind of simulations before they get the results. Now, if you look back 10, 20 years ago, an ALM system sits in front of an analyst. He can do any kind of simulation, run the results, take a look at it, and they can do kind of hedging. By the end of the day, they will have the next day they will have the new reports. This day, everything is locked up in the sense that when you need to make a change, you need to go through a change request, you need to get approval, then you get the results a few days later. So without the timely informations, the analyst can't react to the market. If SVB failed in 48 hours, how long does it take for you to produce those reports? So these are the things that we need to be aware of. The last thing, what we've seen is a lot of regulators in the region, plus some of the banks, they have gone beyond looking at a simple ALM, an ALM that is focusing only on interest rate risk and liquidity risk. They should be looking at, because risk does not manifest itself in isolation, right? Look at the last financial crisis. It didn't start off as a liquidity crisis. It started off as a credit in the subprime market. Now, in terms of SVB, it started off as an interest rate risk mismanagement, then becomes a liquidity crisis. So when we build a forecast model, how you look into the future, what are the risk factors you need to take into considerations, you cannot be just looking at interest rate risk, cannot be just looking at liquidity risk, you should be looking at a lot of the macro factors. So these are the things that we see development in the ALM sector.
Thanks, Wilson. So you are saying essentially speed is the essence. Akriti, your design is liquidity, treasury, and stress testing lead in Ernst & Young, right?
That's right.
So right kind of descriptor. So you tell us that this emerging need for speed in the entire thing. I mean, theoretically, we know what needs to be done, but how fast things can happen. And one is the Twitter fuel run. I mean, I'm sure most of you know that when what was happening in Silicon Valley Bank, one, I'm not naming the bank, but which shares the same acronym as VV, in Mumbai, a cooperative bank, saw almost run on it. There's a long queue because this is the Twitter fuel run. You know, that's what a bank can collapse. It would not have taken 48 hours. In 24 hours, a bank collapsed. Imagine what's happening in Silicon Valley. Here, a cooperative bank which has nothing to do with this, and they had to put up full-page advertisement in newspapers that we have nothing to do with SVB, because there was people queuing up for money in that particular bank. So that's the kind of thing. So speed is the essence. Tell us from a consulting point of view, what's your take on this? How does the Indian bank prepare themselves? How do they prepare themselves? Yeah.
Understood. So from a technology perspective, I think you asked like what is the use of technology in ALM, right? And I'm inclined to agree with that response because you want your technology to be agile and mostly you want it to be nimble, right? So then the question arises, okay, if you have agility and nimbleness, what are you going to utilize that, or how does it apply to ALM? And there are at least 3 aspects that I can think about, and these are also key on top of US regulators as they are now going and talking to all of the banks. The first is sensitivity analysis. Your ALM capability should allow you to understand which of your assumptions are most sensitive to interest rate changes and then monitor those over a period of time, because different assumptions may become more sensitive and have a larger role to play as the interest rate regime evolves. Second, backtesting. You should be able to backtest your asset liability or EV and NII metrics on a more frequent basis. SVB is a great case in point. SVB's models were saying that their NII will increase. What was actually happening was their NII was decreasing because they were replacing non-interest-bearing, non-maturity deposits with interest-bearing, high-yield broker deposits, right? So you have to have the capability to backtest what is my model telling me, what is actually happening out in the environment. And in instances when the interest rate regime is shifting so quickly as we have seen, it's only been 6 quarters from the start of 2022 till 2023, we've had a substantial increase in the interest rate environment. You want to be able to backtest your models and your assumptions more frequently, at least quarterly, right? And finally, to close that out, the third thing for which you need that nimbleness and agility is scenario analysis. Systems will have certain configured assumptions, you would have calibrated models, but you will want, when you see the shift in the interest rate regime, you may want to test other interest rate options. You may want to test higher shocks, greater magnitude shocks. You may want to actually test the bank run that happened for SVB. You want to evaluate that if $40 billion went out my bank tomorrow, what would that do for my capital? So I would say that definitely need for speed comes, at least the top 3 things I can think about would be sensitivity testing, back testing, and scenario design.
Thanks. So these two, Wilson and Akriti, spoke about the role of technology and the speed. And the bankers here, they spoke about what's the asset liability in terms of deposits and credit growth. So quickly going back to you, and this time we'll start from this side, Damodaran, from you. Your phone is ringing? Okay, yeah. Can you tell us, I mean, again, maybe 2 minutes each, that again, as I said, our bank, there is no crisis. We are safe, rock solid in every which way you look at it, this and all. But is there any lessons that internally you have learned? Yes, RBI is now becoming more aggressive. That's a separate story. But internally, is there any changing in terms of asset liability mismanagement, asset liability management? You are looking at things, learning from SBB, like reconfiguring your bulk deposits with granular deposits or anything else. Again, I am not talking about your bank per se, but as a banker sitting in your perch, each of you can tell us, is there any kind of impact, is there any change, the way you approach ALM?
See, fundamentally, any kind of risk which relate to bank will ultimately translate into a liquidity risk, whether it is a credit risk or a reputation risk or an interest rate risk. The culmination point is liquidity risk. So, in specific case of SVB, it was more of a connected liabilities, connected asset, so connected parties were there. So we also do the internal assessment of how it is connected to the segment or a particular area where this kind of run, if it happens, how it will impact the this one. That's the kind of assessment what we have done. And also the bank in India, generally they have a wide customer base where the risk is very much penetrated in that way. We are not seeing any bank which is concentrated to a particular segment or a particular this one. It's morely wide, and the deposit base comprising of millions of depositors. But having said that, I mean, we have the contingency funding plan, which is a mandatory requirement from RBI side also, which talks about the various funding avenues in case of a deposit run, or what should be the sequencing of that contingency funding, or what will be the cost if we borrow from a premium from market, and how it is related to our it will be taken in our capital computation in terms of ICAP capital and all. So we have pretty robust, and because of the presence of SLR, and upon that we have introduced that global regulation of LCR also. So in that way, we have adequate this one. What Tamal was pointing out about the market liquidity of that instrument, we have seen that in time and again RBI is coming out with various initiatives in terms of providing adequate liquidity to banks even during COVID also, even in any crisis. Some kind of additional comfort which is given by a regulator also. In that way, we are spread across this one, and couple of learnings are there, like the connected parties and IRRBB guidelines coming in. So we will be more going through the rigorous effort of calculating the entire book, how it will turn out to be in case of a various six scenarios what RBI is talking about. And we also have to come out with the internal scenarios. So that's a learning from the SCB and other crises.
Venkatesh, over to you. RBI governor has been continuously talking about, of late, periodic stress tests, and of course that building up adequate capital buffer for any kind of future loss, which is the new RBI language. And the backdrop is, of course, what happened in the US. So your take?
So just if we analyze what exactly happened with SVB and vis-a-vis what are the guidelines which we have in India, by design we have very good immunity with regard to these kind of incidents. If you look at SVB, it was almost 80% of the deposits were non-insured deposits. So if you come to India, it is almost 54% to above 54. That is the insured deposits which is available. So to that extent, people are well protected. And when it comes to the HTM book, it was almost 80% of the investments were in HTM. That is never possible in a situation in India where we have a cap of 23%. That itself is a very good risk management tool which is available, which is built in. For a period of time, we are again going to bring it down to 19%. So this 23% HTM, when it was 19% and when it increased to 23%, we were always thinking, what is the logic of this? Definitely when so much of liquidity, we need to have more HTM book. So that time we never realized. When the situation, we experience it now, really that is one of the big cushion which was available for the bankers. And when it comes to the deposit concentration, that is something which still Indian banks need to look at more rigorously, because the concentration currently is almost 6%, the top 20 depositors. So it is almost 6% of the book, and it is more skewed towards the private sector banks when we look at. So almost 22% of the top bulk deposits are coming from the bulk depositors is in the book of private sector banks. So when it comes to the crises and other things, according to me, the private sectors are more vulnerable compared to the public sector banks because of the nature of the institutions. So there is a need for continuously looking at and monitoring this concentration of deposits and try to diversify it. And looking at the situation which happened because of the social media thing, where the communication is very important. When a situation like this comes, it has to be properly addressed right time so that they can arrest such things happening. Second one, the Indian system does, even for the global, especially on the retail side, we don't have non-callable deposits. So that is something which makes us more vulnerable, because in a situation like this happens, entire thing can come and sit in the one-day bucket. So whatever buckets you are doing it, because of the embedded option, everything can come and sit in one-day bucket. And with net banking and no cap on the transactions, especially with the corporates, the flight can happen. What we have seen in American bank can happen in India. So we are not immune to that. So that vulnerability still exists. So we need to plug these things, and maybe certain deposits on floating rate deposits, and assessing the concentration of deposits which in the books of the bank, as well as looking at some non-callable, that certain things we should test and try. That's what the lessons we can learn from this incident.
Thanks, Venkatesh. I mean, we are not going to explain what is the HTM, etc. This is little technical, but the audience can appreciate that. I was just before coming here, I was going through the latest RBI annual report on this currency and finance. They're talking about the average CASA, that is current and savings account, of private, public and foreign banks. It's not small finance bank and payments bank. They're in their 40s. You know, I don't remember, some set of bank is 46%, some is 42%, some is 47% and all. So yes, there are few banks could be still dependent on bulk deposit, but overall in the industry is concerned, as I said, more than 40% is granular deposit, that's CASA, which is. So yes, Mahesh, your turn. Sorry, I mean, I've got that thing here. Damodaran, your turn. Yeah. So is there any soul searching after what happened in US and RBI's pressure within the bank, within the banking system? Again, I'm not talking about any particular bank. The way you look at ALM, are you now looking at it in a different way?
The case of SVB, according to me, is very difficult to happen in Indian banking scenario. Mainly thanks to the way a regulator has done with the regulations in India.
Because Ms. Viswanathan had left for airport, would you have said the same thing?
No doubt, no doubt I will. Because finally, our regulator, you see if, for example, say regulations, applicability of regulations. LCR is applicable even for all scheduled commercial banks. Whereas in case of SVB, it is the 16th largest bank in US, but LCR was not applicable to, they were considered a small bank. Now you have seen the contagion effect of that. So that may not happen in that way in India. One thing, the regulator, by regulation itself is doing that. LCR kind of ratios, all the Basel III liquidity standards, comprising of your SLS, your stock ratios, everything is applicable for all banks, all scheduled commercial banks. So that takes care of most of the Indian banking system. And again, coming to the other side, that is nudging on risk management, what they do internally when they come for a supervision, or when they, now it is not coming for supervision again. It is a continuous supervision that is happening. Though they may be coming to the bank for once in a year, they are continuously monitoring you. Simply, for example, when the Yes Bank issue happened, for months together, we were required, all Indian banks were required to submit their structural liquidity statement by 6 a.m. next day. That is the way regulator is looking at. And the way, you see, if you see actual assessment under ICAP, Pillar 2, the way banks are required to see not their asset side or investment side, but also their concentration of deposits, their liability concentration, and all the things they need to look at. They need to conduct stress testing under different severities, not only limited to stress test prescribed by RBI. You have to conduct your own stress test depending on your vulnerabilities. So ICAP itself is a horoscope of each bank. That is what I would tell. So regulator is well aware, stress testing is there. They know very well the impact, and they nudge banks which are seen weak. So thanks to the regulations mainly, because if banks are left to do anything to their freedom, yes, SVB can happen. But fortunately in India, that is not the case. That is what I feel.
Mr. Viswanathan is very happy hearing you.
Okay. I am a risk manager. Same opinion may not come from a business side, but okay. From my side anyhow it is.
Biju. Biju, no more makhan for regulator. Okay, so no. Okay.
Before this panel itself, we had discussion on the same topic.
Hmm.
So the opinion is same only. And listening to the last,
that will be very boring if you have everybody has the same opinion.
No.
I'm
not going to repeat that. I'm not going to repeat that. So he was telling about that intrusive regulation as well as what you call micromanagement. So now the paper reports are there about the business model assessment. I don't think this business model assessment is not a, I don't think that it is a micromanagement or intrusive kind of thing. Because by doing that, what I think you'll gain actually, see each bank will have a policy, internal policy and strategy. So with that actually they are going ahead actually. So, but they may not be exactly knowing what is happening in the industry. But regulator will know the fact from each and every institution. So naturally they can find out if there is there any bandwagon run is there, any correlation is there in all strategies. That can create risk later on and not immediately. So that kind of a regulation is good actually. It's a kind of a proactive understanding and sometimes taking counter-cyclical action also. But both are important actually, because understanding the thing on a real-time basis and taking action which can counter-intuitive also sometimes. It may not be acceptable immediately, but after some years, that will be very relevant. And one more thing I want to just sound it off. We are talking more about LCR actually. Another liquidity ratio, which is slightly longer term or medium term, is NSFR. That is also very important because that is available stable funding divided by required stable funding. That also we need to have above 100%, just like LCR. That is actually very important actually, just to understand how strong the liquidity each bank is having. So in that front also, I think Indian banks are on a strong foot. So, and another thing, again, it was already talked because SVP had a lot of concentrated liability. That kind of a liability structure, I don't think any of the Indian bank is having.
Look, you just conclude that and also throw some light, like one product which is a floating rate deposits. It is not taken off. You don't, nowhere you get any number, any data, etc. Why is this? It's also part of the liquidity management. Bankers should encourage that. Why is this resistance?
So I was about to come to this.
Yeah. If anybody has any question, we'll take a couple of questions before we come to these two persons, and we'll ask the lady to conclude it. But before that, if you have any question, just get ready. Just very precise, just one line question to anybody. No bank specific question. We are talking about industry. Yeah, please, Alok.
So I was about to come into this particular aspect on the floating rate deposit.
Because well, once you have that in a right kind of proportion, then a lot of things can be addressed in ALM, right?
Right. So see, this question is very, very pertinent because when Damodaran asked, on the floating rate assets, right? So it's very, very pertinent. So, while there are a lot of things, there are a lot of regulatory push, but for increase the transmission, you have a floating rate assets which have been created, and there's a lot of push. But unfortunately, the floating rate deposits have not taken off. So while
and every asset is floating rate asset in India
not every asset is floating rate
but
asset.
Still in percentage term will be?
If you look at around 50% book. Because
only 50%?
Yeah, depends on the retail book side. If you look at, some of the personal loan segments, if you're the unsecured segment, you will find it a fixed rate.
Okay.
If you look at the vehicle division, these are kind of fixed rates assets.
Mortgage is almost floating.
Mortgage is floating.
And corporate
loans also have a mix of, you have short-term loans and long-term loans, right?
Yeah.
So it depends on, so at an industry level, I may not have the right number, but in my sense, it could be around 50%.
Yeah.
Yeah, so floating rate deposits are not taken off, while the asset book is, so how do banks manage
What
this?
it could be, a few percent, 1 or 2% of the banking system, or what?
Sorry, come again?
Floating rate deposits will be, right now we have 184 trillion deposits.
Right.
Indian banking system has 184 trillion deposits and 139 trillion credit. So if you say about 50% of credit, 55% of credit is floating rate, among the deposits of 184 trillion, is it 1 or 2% will be floating? Not even that.
It will be more, right? So because if you talk about, if you talk about say 80 odd trillion as your floating rate assets, right? And then you have entire 180 or something as your liability. So it will be somewhere close to say 30 odd percent.
No, I'm saying floating rate deposits over the total deposits will be
It's hardly anything.
That's
hardly anything. It's not a non-starter. It's actually non-starter because people tried. I remember IDBI started floating rate deposit, didn't take off. I think some other banks also. Some people tried in the international IBUs floating rate deposit. There is some traction, but overall, if you look at as percentage of share, is hardly anything. It's very fractional.
Okay.
So that created some sort of mismatch. So what banks have been kind of mitigating the risk because assets are floating, liabilities are kind of fixed. So to match the interest rate and the duration, so they have to have a medium kind of a as we were discussing, the deposit duration becomes 2 to 3 years. So duration of deposits has not been going upwards because your assets are floating. And to manage the asset ALM profile, deposit liability, the deposit duration has not been going up. That's one of the reasons. Somebody asked me during the discussion why the duration of liability is around 2 to 3 years and why everybody is looking for these guys. I said it's because the asset duration. Asset duration is where we are stuck, right? While their assets are long term, but because of floating rate, the duration is not so high. They are repricing very faster, 1 year, 2 years, and there are fixed rate assets. So overall duration may not be, maybe you're close to 2 years, and that's why people are looking at deposit. So that's one thing which I think something needs to be done. Some sort of push on the bulk deposit especially should be compulsory, or maybe some sort of push that there should be some fraction of floating rate deposit compulsory, or I'm not sure because the environment has not been so conducive to, or the traction is not there among depositor to put in a floating rate deposit. They want more surety in terms of what kind of returns they'll get. So I think there's no traction there. And second is, I think, is also the deposit pricing. While we talk about asset pricing, risk-based asset pricing, deposit categories are also not same. The risk associated with the wholesale fund, with the retail fund, with a financial institution, or with a small business entity, the risk associated is completely different. Whereas the current framework, while for a smaller depositor, I understand the rate can be same, you don't want to discriminate. But when you go at a higher interest rate, higher amounts, so there is, right now the regulation doesn't permit. You have same pricing on a, you can't discriminate deposit if you accept a deposit on a particular day. While the risk is different, right? The stickiness of a different. So maybe the things may evolve over a period. Just kind of,
since Mr. Viswanathan is here, I'm tempted to ask you,
I'm
sir.
just trying to differ. I'm just making a request.
I am tempted to ask you, sir, can you just tell us why floating rate deposit has not taken off in India? Is there anything RBI can do at this point of time?
Very clearly, in floating rate deposit, you are respecting the depositor. Look, the banks are not able to take a view on future interest rate, right? You are expecting the depositor to take a view.
Okay.
This is difficult, right? And he is an ordinary person. So I think, if you ask me, and globally also, even inflation index bonds have not taken off. Because the problem is the benchmark. So we must understand that you are expecting a commoner to fix what a connoisseur is not able to fix. Okay, so regulatory, I think there's no bar per se, but globally, it's not India. Globally, in fact, I don't think there's any country which offers floating rate deposits. You could have bonds, but floating rate deposits, because they are meant to be for ordinary people who are saving, who want a stability of their interest rates. So if you look at how the regulators are even reverse, it says that when the interest rate goes up, he can break the deposit and reprice it again. But the reverse is not allowed. Okay, so the focus is on the customer. He shouldn't lose and he should be shortchanged. He shouldn't be shortchanged.
You can't make it mandatory for certain segment. It will be,
so again,
like he is suggesting, bulk deposit could be floating rate.
One of the things I like this idea, maybe we'll have to look at how it functions, is that is there a risk-based pricing of a deposit? Today what happens is what RBI has said, between two depositors who come for the same tenor of deposit at the same time, you cannot discriminate. That's the rule. Okay, whether they can discriminate between two depositors, one who says I want deposit is part of his treasury management, and someone who comes with a normal fund management. So you'll have to look at whether there is a risk-based pricing between two deposits, same size, same tenor.
Not allowed.
Maybe something that we can should be examined. I'll put it that way.
Thank you.
Not the right guy to commit.
Thank you. Is there any question? We can have one question. Is there anybody have any question?
I just want one.
Yes, sir, please.
So one of the things is, we talked about the SBB kind of issues. So two things are important there. Time has become essence because, see, you talked of SBB having queues because they didn't have internet banking, people. With internet banking, you just don't have to see. You just click a button and the money is gone. You don't have time, okay? So the point I'm saying is, how do you, the entire management framework in terms of timing, it's silent, it is a silent run. There's no physical run, okay, number one. I'm answering, the question that I have is, do you want some of the ICAP numbers, for example, what is, what do you call, Pillar 2, particularly say IRRBB, with respect to say unrealized losses, no? Would you want that to come to regulatory capital?
Who wants to answer quickly? Thank you, sir. We'll not take any question. Yeah. Yeah.
My opinion is whether it comes to regulatory capital or not, capital adequacy should take that also into account. There is no other go. Either under Pillar 2 or under Pillar 1. That's all. But anyhow, it is there. As part of Pillar 2, you need to keep it.
Okay. One question, somebody's, yeah, please quickly. Just introduce yourself and one question.
I am Dilip Munida here from UCO Bank. I am very simple question, but sometimes it seems very critical. This is regarding the ALM. Sometimes we go for the infra asset creation, where the infra finance we need to finance for 15 years and above. But our deposit do not have 15 years. On the 5 years bucket, we can take maximum, and the core deposit, we can take it as a long-term deposit. But how do you consider, how do you match this core deposit with the 15 years finance?
Venkatesha, over to you. Because takeout financing has not taken off in India, so it's very relevant. Yeah, tell me.
I'm really happy that he has recognized the problem first. So the problem which we are facing is none of the commercial banks are recognizing this ALM mismatch. Still the pricing is going in such a way that we are not able to match the pricing for long-term assets. The risk-based pricing is really a big question mark. Because as if it is a short-term loan, that's how the pricing is happening. So when you look at your profile and try to match based on the risk assessment and the tenor premium which you have to load, definitely automatically your ALM will take care. That is one part. And when it comes to the takeout financing, absolutely no worry with regard to takeout financing, because once the whole infrastructure, the risk lies only at the construction phase. Once it is done, the counterparty risk almost it is eliminated currently. So everything, whether it is the road projects or it is on the power, so the cash flows are quite assured, and a lot of structures are built in such a way that you have a HAM models not only flowing in road projects, it is also in transmission, as well as in some of the best projects of Namami Gange, which is the recent one, is the best model with respect to the counterparty risk. So when it comes that stage, even the commercial banks are not willing to shed that. They want to continue with the asset. So the thing is, at the construction period of 2 to 3 years, where exactly there is some kind of backup which is required, but that risk has already been taken by commercial banks to a great extent. So ALM is not a big concern with respect to the asset, but definitely they have to look at the right pricing, which automatically takes care of their pricing on the deposits and mobilization of deposits to match that. That is what I feel.
Thanks. Akriti, quick one-line answer from you. What Mr. Vishwanathan raised is, in these days of internet banking, without even knowing that your bank can just see that everything has gone. So in a context like, in a country like India, do you see this kind of situation can happen with the banks more and more emphasis on internet banking? And if it happens, how do we prevent it? Quickly, one sentence, 2 sentences.
One sentence for all the things you asked me?
One or 2 sentences, yeah. Because we are running out of time, yeah. 2 sentences, 3 sentences.
Fair point.
Yeah.
So I would say, I don't know the exact demographic number, but a majority of India's population is below 35 years old. And that means that they're on Instagram, Twitter, that's how they've grown up, I've grown up. And they're used to internet banking and the convenience of it. So I think in that context, banks should consider, they should use internal stress testing, somebody mentioned that, as a tool and segment their portfolios so they can appropriately identify concentrations and channels of acquisition. So identify what portion of your deposits are digital or online deposits versus acquired through brick and mortar. Understand what is your industry concentration and where your risks lie. So I would say that yes, India is digital India now. A majority of our population is very young, likes the convenience of everything being on their phone. And so banks should prepare for it using appropriate segmentation.
Thanks, Akriti. We heard 5 bankers, we heard one consultant, and of course SAS is there. Now Wilson, I have the most difficult question for you. If you heard all of them, they said, whatever is happening in US, we don't care. We are sound, absolutely in terms of capital, we have enough capital. In terms of liquidity, there is absolutely no problem. And also, if you see the micro scenario, the kind of inflation US experienced is much higher than India, and the kind of interest rate US Fed gone up is much higher than India. India come from last May 4%, from 4% to 6.5, and this could be the terminal rate. So 2.5% hike, which is compared with US 5.25 to 5.5%. So nothing we don't care about. How do you do business in this market? Yes, tell us.
That is, I have no answer for that question.
Okay. Now, so if you don't have, I can't force you, but tell us 2 sentences to them what they should be aware of at this point of time. And is this, do you find them overconfident, or what are the things they should, red flags they should be aware of?
I think
the
for
banking
banks,
community.
complacency is a big problem, right? I think a lot of these banks, look at SVB, they were so confident they were they were voted as one of the best banks just before the collapse, right? So I think don't take things for granted. Invest in a good ALM solution. One that you can, make sure that you can forecast all the things and prevent things from happening. Thank you.
So thank you. So with that, give them a big hand. You have given to Wilson, but give all of them. Thank you for being with us.
Thank you so much, all the panelists. It's difficult to sum up such a robust and exhaustive discussion. Let me do the fool's errand, so to say. So I think the sum and substances this panel discussed, there is need to redefine ALM risks and need to try new products and regulation to manage it almost on a real-time basis for the young audiences. That's my takeaway. I'm sure people have other takeaways. Thank you so much, panelists. Thank you so much. How it is written, there's no नहीं है नेक्स्ट जनरेशन एलएम के बाद देंगे ही नहीं May I now invite Mr. Sudhanshu Sharma and Mr. Wilson Yap from SAS for the next generation ALM presentation, please.
presentation? Yeah, sure. Good evening, everyone. What an amazing round of discussions we have had. And it's hard to follow up what has just happened, with Mr. Vishwanathan and a panel discussion on ALM. But I'll take this opportunity because all of you are so well primed to understand asset liability management and the system that surrounds this, that I would add my 2 cents, sort of add a neat little bow around whatever has happened till now. And then we'll get into aspects of how do you go around building a product which can cater to all of this. We've had functional discussions, we have had technological discussions, but how do you bring this all together? So that's what we are calling this. We are calling this next generation of ALM. We have need for speed, we have, we need to cater to different kind of products. We have a lot of functional requirements, but then there is the return of classical risks too, but in a different way. A few things are eerily same, but at the same time, how they happen with social media, some of the things that we discussed, and with a lot of technology advancements, the silent bank run, as we heard it. How do you cater to all of this and develop a product around this? So I'll begin with, a lot has already been said about, what happened in the United States, but it's just the return of classical risks. And why? The failure of Silicon Valley Bank was sudden, yes. It was social media fueled, yes. It was sort of a silent bank run, yes. But what went wrong was all the same. There was nothing new. It was an interest rate risk converting into a liquidity crisis. And we have seen this happen across history, be it the savings and loan crisis, be it what happened in Japan with the banking bubble crisis, or the 2008 crisis, the global financial crisis. So all of this has been repeating itself, but in different forms. The World Economic Forum has cited a few things here. In 2023, when we began, the world order had energy crisis, we had a cost of living crisis, and we had inflation. We are still dealing with most of these, and these are essentially the elements which are going to guide us, dictate us for at least a year or two. So in the aftermath of what happened, there might not have been a contagion in terms of between banks, but definitely there is a contagion of what you may say thought process across regulators, across governments. There was a lot of introspection in the aftermath of what happened in the United States. There was a lot of discussion. And again, the same kind of frustrations came out. Investors don't like surprises. Depositors like to get their money out as soon as possible. And sort of how do you deal with all of this? So there were discussions around early warning indicators, and in India, to be very specific, there was a Financial Stability Development Council which came up with certain reasoning around all of this. What we wanted was some early warning indicators. For example, your stress testing and scenario analysis, which we discussed in a lot of detail, your liquidity and cash flow risk management. how do you do recovery planning around all of this? You can construct reverse stress testing scenarios, what could lead to a failure. But then again, doing this at a bank level in an integrated manner is something that matters. Interest rate risk, market risk, credit risk. All of these may or may not affect your ALM systems today, but they will affect your ALM systems in the future, especially when you do dynamic modeling of your ALM systems. How does credit risk feature in? Are you taking into account probability of defaults? Some of these questions are very difficult to answer and equally difficult to integrate into an asset liability management system. On your left-hand side, I've just provided an example of what a good system can do. You're seeing a screenshot of a system that we have, which is called Risk Information Services, so Kamakura Risk Information Services, which is now part of the SAS offering. Very early on, we found indicators that all 4 banks were in deep trouble. If you look at the 1-year default probability, it was in the 90th percentile. What you also see is their 1-year default probabilities were greater than your 5-year default probabilities. So all of these metrics help you be informed. And that's the title of this slide. Better insights deliver better banking. So how can you get better insights through your ALM systems? Now, a lot has already been said. Analysts have spoken on this. Regulators have definitely spoken on this. But we decided to conduct a survey and get it from the right source. So there was a survey conducted by Celent in collaboration with GARP and SAS. And we wanted to find out what bankers are really looking for. The overarching theme that came out in terms of next generation of ALM is 80% banks are looking for a comprehensive change in their asset liability management systems. And when they are looking for this change, they are looking for certain specific things. They are looking for dynamic asset liability management. They are looking to model non-maturing deposits. They are looking to model their withdrawals. They are looking to model their prepayment risks, something that is more behavioral in nature. So all of these functional aspects, especially in India, with the introduction of the IRBB guidelines, there is a lot of stress on how you would model some of these behavioral aspects. So the bankers did tend to come out and speak along the same lines that all the analysts have been speaking. But at the same time, they had pointed out certain specific functional aspects in terms of also the need for speed, as Wilson had mentioned earlier. How do you do this in a specific amount of time? Because the more modeling you add into a system, the more runtime it would tend to take. So you need to optimize your system capabilities. Taking all of this into account, what do we feel a next generation ALM system would comprise of? Of course, it would meet the regulatory compliance requirements. That's the bare minimum that any asset liability system needs to do. But at the same time, what else needs to be added on top of it? Efficiency in terms of governance, in terms of high performance, grid computing, in-memory computing, all those technological aspects need to be brought in to your asset liability management system so that you can do all of this analysis, not just at the end of the day. You don't want to do an end-of-day analysis only. You need sandbox features. You need your analysts, your business users to be able to do all of this on the go. So you need these aspects, bare minimum, in your asset liability management systems. On top of it, you need a full coverage. And India, we have experienced as product developers that India tends to have a lot of variations on its asset side. So you need to have full product coverage. You need to look at dynamic balance sheet management, again stressing on this fact, not just in terms of static balance sheets or running down your balance sheets, but bringing in new business assumptions. How do you price those new businesses? So you need to be capable of doing all of this. At the same time, stress testing and simulations while you're taking all of this into account. So a good and a next generation asset liability management system should be able to cater to all of these requirements. With that, I'll pass it on to my senior colleague, Wilson, who has a lot to say on designing such systems, and he has a lot of experience in implementing such systems. So over to you, Wilson.
Can I click that? I've decided to skip this slide Okay, but I'll come back to it. Every time I flash this, I see frowns. Okay, not that because it's small, but because it's perplexing. What does this mind map shows you? It's a mind map of an understanding of what an ALM system should look like. Okay, we did a survey, we did a workshop with a number of banks, CEOs, CFOs, CROs, and we asked them what exactly confronting you. Don't worry, you can't see the small words. I'm going to go through it one by one with you. So when we ask that questions, when we ask that questions, just give me 1 minute, let me borrow. The first thing that comes to their mind, all bankers, is about cost, right? So there are two types of costs we classify here. The first type is what I call a cost of goods sold. The bankers is saying that I need to keep my cost of HQLA down. Those are expensive stuff, right? I need to save on my capital because they are expensive. I need to make sure that I control my loss provisions. So all these are related to integrated balance sheet management. Now the other part of the cost is basically the OPEX cost of compliance. Every time the regulator come up with a new regulations, the banks are buying a new system, right? So let's say that there are 4 things that you need to be compliant with, right? So you do the ETL 4 times, you map it into 4 different systems with 4 different data model. Now you have 4 sets of results that you need to reconcile between them. The regulators are coming back. I mean, it's coming to you and asking a lot of these questions. You're sending all the different reports to the same guy. They'll be looking at it and asking questions. If they are not reconciled, you better watch out. So how do we, from SAS, answer these questions? It's a very simple approach. 4 different requirements, 1 data extractions, mapped to 1 system, with 1 data dictionary, 1 engine, 4 sets of results. So basically, you cut away all the operating expenses where you have to maintain 4 teams of people to maintain 4 systems. 1 team of people, 1 system, 4 sets of results. That's what we bring to you. And when we dig further, other than the cost side, so what other functionalities you want to see so that you can help you manage your business? This is a part, facilitate business planning. A good ALM solution, first of all, you bring in your existing portfolio, right? Now, then you bring in your business plan with 1 year, 3 year, 5 year business plan. You let the simulation engine runs so that you know what your future balance sheet will look like. Any point in time, 1 year, 2 year, 3 year down the road. You put in your business assumptions like rollover. So these are the part on the simulation engine. Straightforward. Now that you have how your balance sheet looks like in future, any given point in time, how your P&L will look like, the next thing you have to look at is, in your business plan, what kind of risk do you inherit? Or did you, I mean, look at SVB. They grow their deposits 3 times over the span of 3 years, right? That is a bad business plan because when they invest the excess fund into the fixed income securities, they inherit a big risk without them knowing. So the same system with the same data, on the compliance side, on the risk compliance side, it covers IRBB, LCR, and SFR. But we can't stop there. You know the balance sheet, your P&L, in future, what these risks are like in future. The next thing is, how about stress testing? Now, the regulators' way of doing stress testing is very lenient in our opinion. And to us, it's a bit overly simplistic. The reason is because in the real world, what you are exposed to are much more than that. For example, other than the interest rate risk, interest rate moving up and down, how about your macro factors? How about your FX rates? How about unemployment? How about oil prices? All these macro factors has an impact on the customer's behavior, right? How they are being affected by all these macro factors will have an impact on the way you manage business, on your business plan. So when we came out with this together with the banks, they realized that every single node here represents a variable, that every one of them that you move it has an impact on the other side. So this is what the next generations of ALM is about. Integrated balance sheet management. How do we do it? We make it extremely, extremely simple. We make it into an Excel type of spreadsheet. It's like a template. No coding needed, where user analysts can go in, just key in the variables you want to set up. So for example, in these situations, I have 3 scenarios. We did for a bank. And this is for, during the COVID time, we're trying to simulate, after COVID, what if there is a quick recovery, a slow recovery, or there's no recovery. So you can see here, for example, the different risk factors, GDP, CPI, PMI, and all the even ratings as well. Under the 3 different scenarios, how we have different variables. So we make it extremely simple for you. One processing screen, where you put in all different variables into one process. In this case, in this single process, I include new business, my assumptions of how my new business is going to become, my FTP, how I forecast my new balances, my capital, RWA. 4 different requirements doesn't mean that you need to have 4 different systems. And this is what you get. This might look very familiar to you. Let me just go through this. On the left-hand side, what you see is line of business, your product, your chart of account. And as we move towards your right, we get the results for ALM, FTP, IFRS, RBI, RARO. I'm sure that you have seen this report, but not together. Probably 4 different reports. Now with one system, one single assumption, one data dictionary, you can put this together. And why is this important? Remember, if, for example, I'm looking at the business banking term loans. In the past, if you make a decision how you want to grow term loan, you're only looking at ALM in silo. You do not know what is the impact on your capital. You do not know what is the impact on your FTP. You cannot have a comprehensive view of that decision you are currently making. And the same assumption and the same risk matrix. You can do it for now. You can do it for future period. So, one of the regulators shared with me this story. You know how we train pilot these days? We use flight simulator, right? It's cheap, it's easy. And in the flight simulator, you create disaster. Things like, engine failure, crosswind landing, I don't know, any kind of thing. Then the question he asked me is, would you feel safe if the pilot, he only get trained in the flight simulator that will only emulate one type of risk, one type of scenarios? So if the pilot needs a flight simulator that is very real to a real situations, why aren't bankers simulating your business in a real environment? And this is what we have to offer for you. we have hundreds of clients over the world, all right? A lot of solution providers will come to you and say that we offer exactly this. But we want you to give us a call, give our client a call, and see how we help these 100 over clients fulfill this flight simulator kind of environment for them. So that's all I have to share with you. I hope you enjoyed it, and I hope I give you some insights. And if you have any questions, please. Thank you very much.
Thank you, sir.
And Mr. Yap for that presentation. No, we are running short of time, so we won't have a break. We'll start with a panel, second panel immediately. Yeah, just with the, yeah. 5 chairs. 6, sorry, 6. Yeah. So may I now invite panel 2 panelist. The panel is on IFRS 9 implications for Indian banks. Mr. Deepak Kumar, Chief Risk Officer, RBL Bank. Mr. P.K. Samal, Chief General Manager and CFO, Union Bank of India. Mr. Alok Pathak, CRO of Utkarsh Small Finance Bank. Mr. Dhruv Parekh, Partner Financial Services Risk at EY India. And Mr. Anselmo Marmonti of SAS. Please take the stage to conduct this session. May I invite my colleague Manojit Saha on stage, please. Yeah, Manojit, all yours.
Good evening. So we have a panel discussion now on IFRS 9, the implication for Indian banks. Now, just to set the stage, I know it's informed gathering here, but we are also going live on YouTube. So for our viewers, just a background. IFRS 9 is introduced as a forward-looking approach for credit default. At present, what Indian banks do is the incurred loss approach. That is, when the loan becomes default, then they make provision for this. In the IFRS, they have to assign a probability. They have to find the probability of future losses and make provisions accordingly. One of the important aspects of IFRS is expected credit loss framework. A discussion paper was introduced by RBI in January this year for expected credit loss approach. The RBI has not said yet when they want to implement this framework for Indian banks. But the general expectation is, as some of the credit rating agencies have said, that 1st April 2025, it may get implemented. RBI has said that they will give banks 1 year time after releasing the final guidelines to prepare for the implementation of expected credit loss framework. Now we have a discussion paper. It will be followed by draft guidelines, and then the final guidelines will be allowed. Interestingly, RBI also said that banks will get 5 years to amortize their provisions for this approach. So the ECL model, because the ECL model, when it's implemented, is expected to increase provision requirement for the banks. So to discuss the implications of IFRS 9 on Indian banks, we have a very diversified panel. We have a public sector bank, we have a private sector bank, we have a small finance bank, and we have from EY and from SAS. To start with, let me ask from the small finance bank, what are the main challenges to implement this expected credit loss model that the banks could face going ahead?
Hello, am I audible? Okay. So I think if we talk about, we'll not talk basically on the small finance bank like us, so we'll talk more on the generic side. So the main challenge what we have seen is the data again. So because like when banks are converting or banks are going for the new new kind of products. So one is like how much you have the overall data to take any call actually, because RBI has kept the things very open. So they have allowed banks to do their own homework, do your own analysis, create your own model, and then you come to the proper conclusion. So most of the ECL model, what we have seen, especially if I talk about small finance bank now, it is based on our historical data, based on some kind of assumptions wherever we don't get the data. In terms of overall provisioning, if we talk, so I think difference is there. So you can't deny that difference between the IGAP and ECL will be there. For the obvious reason, in case of IGAP, people are more talking about the only actual loss or maybe that delinquent accounts. And here we are talking more on the even 30 days DPDs. That is a major difference. Having said that, if you see any bank as on date, so nobody is actually keeping just quiet by keeping some kind of provision that, okay, this is my overall book, this is my delinquent portfolio, and I will put only this much of the provisioning. So I think all banks are working like in terms of contingent provision or maybe in terms of floating provision. So this already that work was on from most of the banks. So I think if we talk about in terms of shocks that suddenly, if say what you're talking about, if we assume that 2025 it gets hit. So I don't think that kind of scenario will come where people will be there like capital is not there or capital is not adequate to take care about that provisioning. In terms of data challenges, it is there. But again, I think regulator is very clear that they have given a lot of opportunity to the bank that when you are creating a model, when you are writing, so you should be very clear about your assumptions. No, assumptions can be anything, but it has to be backed by a good document or good series of data. And again, when I'm talking about that, whatever past it has happened, because as you rightly mentioned, ECL is not about the past. ECL is also about the future actually. So like something has happened like in terms of demon or in terms of this COVID. Now how to adjust this kind of information. So I think all these things bank have worked. And I think large bank was quite advanced earlier also based on their advanced approaches. So I don't think that they will have problem. A small bank, because suddenly those kind of information now they have to collect and they have to work it out. So maybe some kind of lookalike data they will take, or maybe some proxy scenarios will take. So we have made model based on those information.
As a small finance bank, are slightly different than any other commercial banks, because 70% of your loans are to the private sector. Is that put you in an advantageous position, or that is a disadvantage? What do you think for the small finance banks?
So see, again, if we talk about how I'm handling my portfolio or a business, that's a different thing. That 70% on a single product, it looks a little very risky. If all CROs sitting here, they will say that how can you even think about that you have an exposure of that. But at the same time, when I'm talking about expertise, so like if I have converted from a microfinance to a bank, or for that reason any particular organization, so obviously that is there in DNA. So their processes are matured, their controls are good enough for that. In fact, I will be more worried if somebody is suddenly after becoming from A to B, and he started going gung-ho on the all sort of product. So I think it is always better to go slow in that term. In terms of, if I talk in only for the ECL purpose, absolutely right, there will be very huge impact the moment you start taking into account what we call stage 1, stage 2, stage 3 kind of thing. Stage 3 is okay, means almost we can say that everybody count stage 3 in a similar manner. But stage 1 and stage 2 makes a lot of difference actually. Now, in terms of historically that what kind of LGD you are going to get it, based on your portfolio or based on the market, how you are going to take into account. Because if you are saying that I am having 60 or 70% portfolio of my historical book, but still I am having 30-35% of the new book, which has not seen anything. We don't have any trail of the same. Then we need to create something. So that is the biggest challenge actually as on date. So that I think there are ways to do it. So like most of the banks are using similar kind of organization. It can be NBFC, it can be bank. So you can get data from different kind of organization, and then you plug in back to your particular model.
Right. Mr. Samal, Union Bank is one of the large public sector banks in the country. The size of Union Bank has gone up after the merger with two other banks. From a public sector point of view, and that to a large public sector bank, what could be the key challenges that you will confront going ahead in implementing the expected credit loss framework?
Thanks, Manojit. Talking about the challenges, last few days or weeks, we have been talking more about the IFRS, more specifically in the ECL. And two things we are more talking about: what will be the impact, one-time impact, if the banks are shifting to the new ECL framework. In terms of what will be the additional provisioning as a percentage of your loan book, or what will be the impact on the CET of the Indian banks, and whether the banks have adequate capital to absorb this one-time additional provisioning. See, we have been talking about the IFRS for quite long time. This has come from the regulator from the 2018-19, and subsequently we had a regulator has deferred it because of certain constraints. You can say one was that you had large NPAs, AQR related issues, and the capital adequacy of the banks. That was the main issue. The other thing was, of course, Pathakji mentioned the quality of data which the bank was having, and the sufficient past records, past behavior of the loans. That was the other thing. And the third most important was whether the banks were having the appropriate technology, right? So technology for modeling, to determine, to quantify accurately what is the ECL that will come. Because as of now, we have a very rule-based, crude approach of providing, based on the regulators' IRAC norms. But then the new ECL approach, essentially a principle-based, forward-looking approach which takes care of your past loan behavior of the loan and the present situation, and also future, how the macroeconomic conditions that prevail. So putting across everything, with a probabilistic model. So technology has to play a greater role. So you have to have an appropriate model. Of course, in the discussion paper, which RBI has said that they will give enough flexibility to the banks to design their own appropriate model for different category of the loan portfolio, etc. Of course, the RBI will specify the floor guidelines based on which such modeling has to happen, which will be subject to the regulatory checking and all and validation. Of course, we're there, but the most challenging part was that putting for the technology that is required for appropriate modeling of this one. So I believe these 2-3 things over a period of time, the banks have overcome those challenges. One is that with respect to the stress book or the capital position, you would have seen now the banks have improved a lot. So the capital position has been improved, the profitability has improved. The stress book, which used to be double digit, now has more or less in a controlled. Specifically, the SMA2 assets are below 1%, if I say, across the banking system. So which attracts the lifetime ECL and all. And if you see the NPA side, most of the banks have already recognized everything and provided around 90% of the provision coverage ratio. So in terms of their ability to absorb the additional provisioning and ability to have the adequate capital. So in whether you have to absorb the additional the provisioning requirement, the banks are in a quite comfortable position. If I look today, and the timeline which we are talking about now, that the draft guideline that has come, and we are expecting probably the banks have already given their viewpoints and to RBI. So we are expecting certainly the final guidelines to come, and you have rightly mentioned that after the final guidelines come, RBI will give us a time of 1 year at least to make it fully implemented in terms of putting across the appropriate modeling and all. So I think the banks are now well prepared, both in terms of their balance sheet strength, and many of the banks, public sector banks also, if I talked about Union Bank or other banks, they have already working in the technology side, onboarded consultants and technology partners to develop the appropriate modeling. Of course, we have been doing this because we have to, every quarter or 6 months, we have to submit the pro forma Indus financial statements to the regulators. So we have already put in place, we have already developed the kind of data availability and modeling based on certain assumptions, but then it may or may not be accurate. Now you have to have a technology, probably few of the technology providers like SAS or Oracle, they have come up with the appropriate solutions that will help the bank to put across the appropriate technology, which has been a challenge. I think down the line, 1 year or so, when we have to implement it, probably that challenge is also to a large extent gone. And considering that now our stress book is mostly benign, so banks will be able to, I think this is the appropriate time to for the bank or banking industry as a whole to take forward this approach. And what is not being talked about is, if you allow me one more minute of time, what is not being talked about, the other perspective of this, I'll mention that. So essentially, from a incurred loss approach, you are going to a futuristic model of expected credit loss. In the incurred loss approach, what you do is basically you have to necessarily wait for 90 days, the asset become NPA, right? Whereas, in the expected credit loss approach, you have to recognize the stress at a very early level. So default being the indicator of the stress, you are not supposed to wait till the default happens. Right. You have to actually recognize the default much in advance. Right. And it is not that provision for default, it is actually the probability. You have to identify the probability of default much in advance. So that is the important thing for IFRS. And if you see the regulatory developments that are happening over a few years, So, AQR that has happened. Subsequently, we had a IBC that come into picture, which said that one day default, right? And you have again that June 7 circular that has brought by RBI. They are also very clearly they have said that you have to recognize the stress as very early stage, at a one-day stress level, and if the stress default going beyond 30 days, you have to appropriately make a resolution plan in the banking system, and if you are not doing so, you have to make provisioning there also. Then the third thing I wanted to also tell you regarding this is how you are actually identifying the stress much early to actually default happens, and through a probabilistic model. With this kind of a environment, identifying the stress at a very early stage, which is the basic principle of ECL provisioning, actually lot of advantage will come to the bank. The banks have already put in place the appropriate system of EWS to identifying the stress early. So all this principle hangs around how early you identify the stress and make necessary provisioning. So going ahead, even though in the transitional, when you shift, you have a one-time impact, but in a long run, you have a very advantageous position in the sense that your provisioning will, your advancement, because you are recognizing the provision at the early stage, so your earning will become much more stable in the future. So you'll take care of any future adverse condition, adverse economic condition like COVID or any other thing. So it will put, it will put the bank in a much better situation to take care of any future, adverse economic conditions. And the bank are also recognizing this, and this will also help the bank to design their, risk-based pricing system, because when ECL comes into picture. So overall, I believe that more than the challenges, you to look into the other side, what is the advantage that is going to come to the banking industry as a whole, and what is the benefit you are getting out of that. So that is my takeaway from the entire, this thing of ECL.
Right. Now, from a sleepy Kolhapur-based bank in 15 years back, RBL Bank has come a long way, and it has transformed it completely in the last 10, 12 years. And the growth was, RBL Bank was on a very high growth path. How do you see this transition to the IFRS 9, given the kind of growth you have seen? What could be the challenges that you have identified?
Let me tell you that I am with RBL Bank for the last 3 years.
Okay.
And out of the 40 years of my experience, 37 years has been in a public sector bank.
Okay.
And so, what I will be telling about RBL banks or a private sector bank's perspective, that perspective is coming from a public sector banker on the private sector banks.
Right.
Issue that I am looking at the ECL is, okay, in the new system, I have to compute expected credit loss based on the futuristic probability of default.
Probability.
LGD and EAD is common.
Yeah.
So, if the ECL provisions are increasing, that needs ideally be covered through the pricing of products. Because that is the only way we can cover provisions, otherwise I will be eating into my capital and that will increase the vulnerability of the bank. In pricing, there are 3 basic components: cost of funds, then cost of operations, and third is the provision.
Yes, yeah.
For a smaller bank or private sector banks, in the Indian banking system, cost of funds are usually higher, because we don't have large granular deposits like State Bank of India or HDFC Bank, where we can afford a savings bank at 2.7% or 3% rate,
right,
and take bulk of deposits. So smaller banks will have to offer higher rates, which increases the cost of funds. With limited manpower and outsourcing, dependence on outsourced activities, cost of operations is also high. And this third component, again, provision getting higher, ultimately what will be the solution? How to price the products? And if I am going to price the products at a higher level, probably I will have to pick higher risk. And that is again a vicious circle. If I'm going for higher risk, then a small bank's balance sheet size, I become more vulnerable. Yes, RBI or regulators have given 5 years leeway to amortize those such increased cost. Right. So that will give some respite, but that is available to all bankers, not only small banks. So from that perspective, and then the second thing that is not exactly, I would say, for a small bank or large bank, it is from the model perspective.
Okay.
In my experience, the model that I have for probability of default that I have seen, India is a very diverse geography. I have worked in north in Delhi, west in Gujarat, east in Bihar and Jharkhand, Uttar Pradesh also, and south in Tamil Nadu. Work culture, credit culture, probability of default is totally different in all these geographies. Even in one state, Tamil Nadu, credit culture is different in deep south in Tirunelveli area. Western side in Coimbatore has a different credit culture. Rest of Tamil Nadu is a different credit culture. So whatever models that the probability of default is predicted, that is not, to my understanding, the right projection of the losses that a banker can incur.
Because the human behavior is not captured.
Human behavior is not getting captured in both sides, from the customer side as well as the banker side. Collection mechanism of different banks are different. So those are the challenges that we need to address in coming times. How to, because theoretically it looks very easy.
Right.
Expected credit loss, probability of default into LGD, into EAD. LGD will be valuation based, EAD will be common, probability of defaults will be coming out. These are very routine things and technical things uniform for all the banks. But practical challenges that I am seeing is how to manage those losses, provisions, and what will be the direction of banking business in coming times with these type of increased provisions.
Right.
To some extent, these issues are still prevailing in the system, but probably that is going to be aggravated in coming times.
Right. So you're basically saying smaller banks are slightly in a disadvantageous position so far as the ACL framework adoption is there.
To some extent,
to
yes.
some extent, yes.
And if I'm sitting in the supervisor's position, for me, whether I am a small bank or large bank, I am a regulated entity.
Yeah. Regulation is ownership neutral.
They will expect all banks to follow the same standards. And because I am telling from my own experience, I cannot expect a small bank to perform the similar way or adopt the similar technological standards or similar strengths that a large bank can have.
No, of course, RBI always maintains that regulation is ownership neutral.
Right, naturally. And it's very natural. If I am sitting on their side, I will also be talking the same thing. As a supervisor, my role is to keep uniformity across the system.
Right.
So those are the basic challenges I would like to touch upon. Of course, Samal has covered the public sector things very beautifully, and Alok also has given the small banks. But I am trying to just make it a more macro level.
Yes, we will come back. Mr. Parekh, so you suggest banks, help banks in advising them to how to navigate through this. So what has been your experience with your interaction with banks? What are they saying in terms of the challenges they are facing?
Thanks, Manojit. I'm audible, yeah? So before I answer that, I think it's important for us to recognize the fact that Indian banks generally are not starting from zero. There has been an entire IRB wave which has happened 6-7 years back, which Indian banks did kind of go towards and kind of did some preparations around. So it's not like they're starting from zero. The second thing is that we need to also keep in mind that IFRS 9 as guidelines have been kind of implemented globally. So a lot of the banks who have international operations have experienced it in some form or fashions and have also kind of observed experiences from, say, what NBFCs are doing based on the Ind AS 109 framework, which is very similar to IFRS 9. What in our conversations, what we have heard and what we've seen is banks necessarily need to tackle this from two perspectives. One is how are they going to implement it? And secondly, how will they need to redesign or relook at their strategy given the expected credit loss framework coming in? And so over here mentioned that as well in some form or fashion. I think from an implementation perspective, there are 4 key elements that any bank will have to look at or are looking at. One is data, which I think is, if you ask any banker, that will be number 1 on their priority. Like, do we have enough data? Do we have the right data? Do we have the right data strategy to actually collect the data for the future? That's I think, number 1 priority for banks as of now. The second element, which I think people are concerned about, is developing the models themselves. And 2 pieces specifically on that. One is the Indian banking industry hasn't been too easy to stress from a macroeconomic perspective because of how our macroeconomic data has evolved. And secondly, the kind of resources that you need are high-end statistical skill sets, which is something that banks are still working on, and that needs to happen. So modeling is the second big piece that...
Modeling?
Yeah, modeling. Or the methodologies that need to be used. The third element, I think, which I think someone did mention, was the system. What kind of technology do you need to have in place? What is the technology able to do? And how are they going to utilize that? I think that's another big factor which banks are concerned about. And the fourth element from that perspective is governance. What kind of governance mechanisms will you have, given the fact that ECL does have a lot of volatility, does have a lot of adjustments, does have a lot of assumptions coming into it? Having the right governance in place is extremely important. And that's, I think, one of the concern areas. Coming from a strategy perspective, I think banks now are looking to, re-looking at their pricing strategy, looking at how they need to rebalance the portfolios if they need to, looking at what kind of collateral coverage will they need to get in to kind of optimize their LGD, looking at how do you kind of also optimize your covenants, so be able to kind of take advantage of that. And then finally, how are they going to optimize their ECL and eventually the capital? I think these are some perspectives that they need to bring in or think about as they make this transition. It's going to be an interesting journey, but some of these elements they need to focus on.
Thank you, thank you. So, how challenging is to incorporate the human behavioral aspects into modeling, because India is a very vast country. One region differs from other region in terms of, not only in terms of language, but also, as I said, in terms of their credit behavior. So, yeah.
Yeah, I believe that this is a very valuable point, and the colleagues also summarized the list of the key aspects. So the point from our perspective is that, again, data will not be, because to model properly, you need to have high quality data. And in many cases, maybe we have partially the data for some portfolios or for some geographies, maybe not for all the areas. So first we need to evaluate and certify the data that we need, also to properly incorporate the behavior of the behavior of our customers in their logic. And on that, the fact is that we can load the data. We are talking basically about credit risk models. So what I believe that is relevant is that the sophistication that ECL is asking is much more ahead and advanced compared to the usual scoring models, meaning that now we are looking for, again, a long-term probability of default. So we need to do an evaluation of a lifetime loan, meaning that if we have in the portfolio 30 years loan, we need to consider that type of length or that type of maturity. So it's a completely different type of complexity that we need to consider. And we need to consider also incorporating this aspect like the behavioral. There is another couple of aspects that, based on our experience, are extremely material. Because again, yes, there are multiple logic to apply the calculation. It's a principle based, but again, lesson learned all around the world. So there are multiple approaches and best practices that we can apply. But one of the key aspects is that we were saying at the beginning, the difference if it's stage 1 or stage 2 is massive, meaning our customers, the key aspect was the calibration of the overall model to really identify how to calibrate the logics to apply stage 1 and stage 2, and then run the models accordingly, 1 year or lifetime. So the point is, this is quite complex because it's the overall cycle that need to be calibrated. The data that I have, the models that I have to develop, the inclusion of the behavioral, how to design the staging allocation rules, run the calculation. And again, a key aspect, we were mentioning, this will become the driver for the pricing, right? But the risk is that, again, stage 2, the risk is that we will be out of price. If we are not able to properly estimate the credit risk models, we are out. So the point is, many times, many countries in the past, one of the error was, it's an accounting standard. Yes, it's an accounting standard, but the core is a risk model, is a credit risk model. So if we don't cover properly that area, after 2 years, banks decided to replace and throw away the investment that they had done. So the logic is really how to have a system that allows them to cover in an adjusted way, risk-adjusted way, the full calculation. And again, you were mentioning some of the interconnections. Are many, because guess what will be the stress testing? The core of the stress testing. It will be I9. Guess what in the planning, what you will need? I9. So all these type aspects, all these type of additional exercises around that the bank has to cover will be heavily weighted on the I9. And that's why we really see, we have really seen, again, a need to properly design, not just as a compliancy, but as a way that will allow the business user to recalibrate, allow them to go at maximum level of granularity, because the difference in the result will be massive. If you try to aggregate, it means that you are tightened in your hands for further decision. So there are many lessons learned that, again, we have experienced it. As I was telling before, we have, 200 plus customers globally. So, and again, we have delivered, because all these systems are in production. We will see also later with the colleagues some of more details on how we handle, but there are many lessons learned that to avoid, again, to repeat errors happened in the past.
Coming to you, Utkarsh has already implemented IFRS 9 from the holding company level, which is NBFC. Can you share some of the steps that you have taken to do so as a lesson from that?
Yeah, definitely. So before that, I just want to add few points on what we were discussing about, that how to get the real, means whatever cost of fund is increasing, or maybe credit cost, what we are talking. So I think that if we can, what you are mentioning, it is perfectly right. If I can identify all those parameters, so whatever my historical data is there, I think that will come with all their nuances. So if my, especially Deepak sir, I want to add on that part. So if my geographical related issues are also there, if I can get the data correctly analyzed, because that will definitely reflect me what is the credit behavior of those kind of customers. And in fact, right now, many banks, many NBFCs are actually working on creating the product pricing, even based on geography also. So they are giving a lot of rebate also, and they are charging risk premium also. So in fact, even it is going as granular as to the MFI portfolio also, NBFC portfolio also. So it is very important to correctly price my loan. So although for a moment we are thinking that the moment we adopt this IFRS, and then immediately my overall provisioning will go up, but we have to think from the overall point of view. So in the long run, definitely it is going to help me in reducing the volatility of my profitability, because I'm not going to provide anything unnecessary. If as a risk head, as a finance person, if I'm not able to identify the stress in my portfolio or my quality of underwriting and my entire credit model, so I think we'll be nowhere. So it is very important that we have to be correctly identify all these nuances, what type of product, what type of client, what type of geography, that how that more than all those things, ultimately we have to take into account about the environment also. How that overall GDP is performing, how other, there can be various ways actually what you can add in these models and get some kind of proper result. So if we talk about this specifically to our portfolio also, so obviously when we have started, gap was quite large. Then slowly because model, whatever model you prepare first year, second year, you are not going to get the perfect model. It has to get mature, it has to be continuously validated, it has to, we have to take into account many other external, internal, all sort of things. And in the last 4 years, we were able to actually get a lot of changes in our model in terms of whatever assumptions we have taken the initial stage. We have again changed the assumptions. In fact, if I talk about my first year assumptions, first year whatever things I have documented, that was before COVID. So obviously I'm sitting at 2023. So my exactly same assumption will not work here. And it is really important for all these kind of models that you have to keep on updating yourself. So obviously we can't completely change everything just because COVID has come. I will say that my model is completely changed. Answer is no. But I have to take some kind of learning from this, like how people are reacting in these kind of scenarios. So I will not take the entire whatever default is happening. I will definitely take into account that if stress is there, what percentage of my clients react differently. So, so we started with the year one, with difference was huge. Then slowly as we get data, we started understanding that why this is coming, and it was a learning for us. We have taken additional provisioning also. So right now if I am talking, so my difference is coming down only. So there is no much difference between my actual IGAP provisioning and when I'm talking about the ECL. So that difference has come down drastically actually.
Now, for a public sector bank, generally public sector banks in India the loan exposure to corporates are pretty high. Do you see a portfolio rebalancing before we move to this expected credit loss model, rebalancing towards more secured loan, gold loan for example, which is the most secured one? Do you expect a portfolio rebalancing to happen?
I think that is happening already.
Okay.
If you see the first few quarters or a few years, 2 years, how the public sector banks have developed their own, risk management systems and all, starting from the underwriting to loan monitoring. Clearly, the shifting has now happened from the recovery to collections, and the banks have developed the collection mechanism and the risk aspects also, how the CRO functions happen altogether independently in the whole loan underwriting process, and the expertise they have also brought in, be it a sectoral kind of when you are financing a road project or a power project or any other industry, the expertise has clearly been brought in. So there have been a tremendous improvement in the loan underwriting and monitoring system. Also the UW system coming into picture, fraud management system coming into picture, a lot of digitization happening, So clearly we are seeing the benefit. Forget about the past legacy portfolio. So we have been seeing that the corporate book has been behaving very good as of now across the, in the banking system. And the public sector banks also have been in the rebalancing. They also know what is the risk in the corporate. So you have seen a few years the shifting has happened towards the retail portfolio. If you see the kind of growth that has happened last year, 22-23 also, 15-16% kind of average growth in retail. And you have also rightly mentioned shifting towards the gold loan portfolio where they have identified, which was primarily dominated by the NBFCs, now clear shifting towards the banks, public sector banks. For the obvious reason is that it doesn't consume much capital, it's a zero risk kind of.
There is no standardized provision.
Yeah, and also customers are shifting the kind of expertise in terms of the TAT delivery system we have been building, delivering the gold loan or any other credit. So clear shifting, and also the pricing advantage. So that has been clear shifting towards the retail from the corporate. But definitely corporate book will be continue to dominate in a major part of the portfolio of the public sector banks. But the way the banks have been now monitoring the corporate book and the underwriting standards, we are not going to see, my personal expectation is that we are not going to see much stress building across the corporate book, and it will be mostly under control. And what we are seeing across the banking system is basically the stress that has been being seen in mostly in the retail book side, mostly maybe because of the recent increase in 250 BPS increase in the pricing that has come into the EMI of the retail portfolio or MSME kind of, will be definitely be leveled out. And there also, if you see the public sector banks portfolio, mostly already their mortgage backed, like home loans or other mortgage loan, gold loans, purely collateralized, and auto loans. So there may be a few instances of delay in payment by the borrowers, but largely we are not seeing that much slippage happening to NPA. That's mostly under control. So clearly we are seeing that the stress book has been gradually, coming down, specifically the SMA2, SMA1 book. So obviously it will have a direct impact on your loan provisioning under the ECL model, because that is what the stage 2 asset, SMA2 asset, which attracts the lifetime ECL. So I think in terms of loan book portfolio, the shift has already happened or happening. So going ahead, you will also see the similar kind of trend clearly. So this shift is being visible.
Right. So we are running late, so try to wrap it up quickly. So Mr. Pathak, Mr. Kumar, it is said that, if your net NPA is lower, if you have a higher provision coverage ratio, then you are well placed to adopt the IFRS 9. Bank of Baroda and SBI, I think two banks have come up with less than 1% NPA. So banks could try to lower their NPA. So do you think this will lead to a capital raising rush? Do you think in the run-up to IFRS, banks would try to raise more and more capital? And will that put smaller banks in a challenging position?
To some extent, yes, there will be some demand for capital in the market. In the first round, when I was explaining you the macro level challenges of ECL, let me tell you some positives of a smaller bank or private sector bank also.
Right.
Because most of our private sector banks are better capitalized compared to public sector banks. Their capital adequacy ratio are at higher level. So they are definitely in a better position to absorb the additional provision.
Right.
Though, theoretically, it should come from the pricing of the product and not from the capital part. Capital should be consumed only for unexpected losses and not for the expected losses.
Right.
So from that angle, but bank will be resilient, smaller banks will still be resilient after providing, they are in a position to absorb the ECL losses easily. Secondly, being smaller in size, they have better control on data. Larger banks have a diverse presence across the country, so their data collection is also not as good as a private sector bank. So I'm just now trying to explain the other side of the private sector also. So data collection is slightly better. Again, they have the challenges because they have got multiple systems, so collection of data within the system and within the bank sometimes becomes a challenge. But more or less, data correctness and purity of data is there.
Capital and data, these are the two main advantages of a private sector bank.
And third part is the collection mechanism. Their presence in the feet on the ground is better in private sector banks that I have experienced.
So from these three aspects, they are better.
So they choose, and they are in a better position to choose the products they can afford.
Right.
And there they get the advantage.
Right. Thank you. Mr. Parekh, so do you think the banks in India are ready, well prepared to adopt IFRS 9? Because recently we have heard from the Indian Banks Association that banks wanted more time. Do you think they need more time, though we don't know the date when it's getting implemented? But that is the burning question. Are banks ready?
Start with on a lighter note. I think whenever you go with this, the banks are going to say we need more time. So there's never going to be the right time for this. but on a more serious note, I think RBI has come up with this discussion paper, and whenever they come up with the guidelines from a position of strength, and I think all the discussions that we've had today does point towards saying that the Indian banks are currently well capitalized, the NPAs are under control, and if there is a good time, now is the time. Are banks necessarily ready from an infrastructure perspective probably there is some work to be done over there, but I think given the timelines that RBI has set out that they will give a year even after the guidelines have come out, and the fact that banks have been asked to perform pro forma statements in the last 2-3 years, I do believe that banks will be in a pretty good shape if and when the guidelines do come into effect and banks are expected to have the ECL computed. I do expect that to happen.
Regulators will be very happy to hear that. It will be music to the ears. On the technology front, do you think banks are ready? That they have a long way to go?
I believe that again, they need to activate soon a process that will allow them to test the quality of the data, being able to constantly recalibrate the model, because they need to develop the model, see the impact, recalibrate the models, and again, it will make a big difference how fast the technology that they will select allow them to do this type of iteration. And the other aspect is being able to perform simulations and some help understanding the delta in the results. Because one of the big issues, I don't know if you have already faced it, but one of the big issues is that you run a simulation, but then you cannot motivate why the results are different. So you start with some iteration, which you simply shock one parameter. That's in the 80s, we were doing like that. Now there are technologies that allow you to do sensitivity and attribution analysis, so you know exactly if some staging has changed, portfolio has changed, what are the risk parameters that have changed. So exactly knowing and allowing the business, not the IT, the business, understanding much better how their portfolio is reacting to the shocks. These three things are, for our perspective, core. And the fact is that you can start with a laboratory now to do these activities, to get ready on time to support, first of all, the business aligned with the regulation.
Right, right. Since we are completely run out of time, I will take just one question. Please identify if there is any. Yes, yes, please go ahead. Please identify yourself, and the question is to whom you ask the question. Yeah, please give me the mic.
So I am Venkatesh from NAFID. So with this IFRS, when it comes into play, so mostly in the treasury book, the segregation of HTM, AFS, everything will go away, and suddenly you will see a different kind of configuration, as a part of which goes into the HTM equivalent category. So absolutely there is a watertight mechanism where you will not be able to shift any securities from that side to the other side, trading side or on AFS side, or even you cannot sell it in between. So ultimately the AFS volume will go up. The equivalent of AFS volume will go up. As a result, the mark-to-market losses will increase. So is there will that result in shrinking of the equity market, shrinking of the money market activities and everything overall? Does it create a kind of a slowdown in the market activity? That is what my point.
Mr. Pathak, would you like to take Mr. Pathak or Mr. Kumar or whoever? Yeah.
So I can tell about this, especially what provision is given in the circular is like you can identify the securities what you want to keep in respective category. So even though they are saying that for STM you can keep it separate, but still you can identify the type of security or amount of security once in a year, still you can do it. Like earlier provision was there, still they have given some. When you are identifying, that time only you have to categorize this, that this you are keeping for sale in the not up to maturity, in between the maturity. So there is a provision given in that.
Okay. Anyone like to add anything on this? Yes, Mr. Samad.
No, I think to support what Mr. Pathak has said. I'm not a treasury person, of course, but yes, under this IFRS guideline, you have to classify the security early, and there is no much scope for shifting. But then this when you are classifying this to OCI, so obviously it will have presently your HTM means you are not actually accounting the mark to market losses on HTM, but that time you have to take it a hit in the OCI, of course, will have an impact on the capital. But these are variable things, depends upon the interest rate cycle, right? So today you have maybe the interest rate cycle has gone up, so you have a mark-to-market loss in the HTM portfolio. Once the interest rate cycle gets reversed, you have, you get the impact nullified automatically. So I think we should not be much worried about this thing. In a long run, it will not have that kind of a impact. So the principle is that IFRS being a fair value kind of accounting that needs to be done. What the broader principle is that you need to be comparable, internationally when the banks are going international to raise funds or this, that you need to be comparable. So, so when you do that, you have to follow the proper accounting system which is comparable globally. So that's it, I think.
Yeah. Thank you. So we have run completely out of time, so we'll wrap up this discussion. A big round of applause for the panelists. Thank you.
Thank you so much for insightful and a very detailed discussion. And how new accounting standards, which is essentially a risk model, will lead to a hunt for data and capital, new modeling framework, and early warning signals. Thanks so much. Thanks for the panelists. Thanks, Manojit. Yeah, of course. Yeah. Yeah. So we'll move to the third panel of the day, the last panel. The panel is on risk decisioning at Indian banks. I may now invite the panelist, Mr. Ravi Duvuru, who is the founder and designated director, Duvuru and Reddy, and member of advisory group of Regulatory Review Authority. Mr. Dilip Kumar Mirda, General Manager, Mid Corporate Credit, UCO Bank. Mr. Om Prakash Seth, CIO of IDBI Bank. Mr. Biswajit Das, Chief Risk Officer, Bandhan Bank. Ms. Shreya Paul, Partner EY India. And Mr. Abdullah Akhadov, Head of Credit Risk Modeling and Machine Learning at SAS. To moderate the session, I'll invite my colleague, Tamal Bandopadhyay, please, on stage. Yeah, all yours, Tamal.
Just one minute. This is one? No, this is my mic. Actually, we should have one more table, so anyway. You don't need any, none need any introduction, so. Very good evening and welcome to the last panel. I promised that we would not take too long because between the bar and you, I would not be a stumbling block. I promise that. Okay. We have enough of ECL, expected credit loss, some bit of interest rate risk in banking book, IRRB, etc., etc. But now, concluding session is on risk decisioning. And that's the most important part. I mean, you call it ALM, you call it IFRS, whatever it is. At the end of the day, banking is a risk business. How do you manage it? I remember early this century, there was only one bank in India which had zero NPA, Oriental Bank of Commerce, before taking over the Global Trust. My reporting days, I'm as old as any of this chair, furniture in the banking segment. So from that experience, I would say that. We couldn't have a better panel than this. We have private banks, we have public sector banks, we have consultant, we have SAS. Everybody is present there. Two of them came from outside Mumbai. They flew this afternoon to join that. So thank you, Dilip Mirda from UCO Bank and Biswajit from Bandhan Bank. So we have all kind of banks there and all. So let me tell you a little story. There are women also here, but don't take any offense. I am told that particularly in State Bank of India, the first lesson when the Treasury guys they are told this story. The story runs like this. A doorbell rings. A lady who was taking bath, because it's pretty safe zone, so she comes out from the bathroom on a towel and finds the gentleman. Of course, the door is a rail door. One can see, but one can't come in. The railing there and all. And she says that, what's it? So this gentleman said, is your husband around? Lady said, no, he's not there. So this gentleman just played a trick. He said, I can give you $2,000. It's talking about US, if you drop your towel. The lady found that it's pretty safe. Why not? She dropped her towel. This gentleman passed on $2,000 from the other side of the door. He left. That's fine. Lady is happy. She got $2,000. Evening, husband comes back, says, did John come this afternoon? She said, yes. Did he return my $2,000, which I gave it to you, gave it to him? The lady said, yes, she gave that money. That was the lessons the Treasury fellows are told in State Bank of India and other else, that basically you be very careful about your positioning. You need to know the other side of it. And since this is the last session and to cheer you up, a very similar story once again, based in New York, one rich lady comes to a bank and says that, I want some money. I mean, she should not be looking for that kind of money, but she was looking for $5,000. He said, but $5,000, what was the kind of mortgage you want to give it? She said, why, my Rolls Royce? The bank gives the Rolls Royce, gives the money, $5,000. The lady disappears. After 15 days, the lady comes back and says, returns the money, $5,000, and also pays $15, the interest of the 15 days. The bankers quietly asked her that, why did you need $5,000 for 15 days? I mean, it really puzzled. The lady said, where else could I put my Rolls Royce? A garage would have cost me a few $100. I just got it for $15. You bank, you kept it in your custody. I did not have to look for a parking space for my Rolls Royce. So that's the other side of it. Again, the positioning. Risk management is, first story was terrible risk for the lady. Second story is not the risk, but without knowing how the bankers can get trapped. So this is, for a change, with the permission of the House, we will not get into all the technicalities. We'll look about the risk, all-round risk, because banking is a risk business. Ravi Dhruburu, you were a central banker, you were an advisor to various banks, now you're a consultant. Now we start with you. Tell me about the conduct risk. That's what we are talking about. Reserve Bank of India is calling bank boards, had discussion with the public sector banks, now we'll have private banks. Now, going beyond all these IFRS 9 and all the technicalities, how do you perceive the conduct risk?
Thanks, Taman. If I have to talk on conduct risk, we need to be here till breakfast.
Yep.
But I don't think you have the patience there. But I think it's becoming very important in the Indian context too. After the financial sector crisis in 2008, regulators across the world focused on conduct risk, because whatever you do, ultimately it boils down to governance and conduct. And I keep saying that, this one risk where no amount of capital can save you. We spoke about so many liquidity risks, operational risks. It's all, you allocate a certain amount of capital to mitigate those risks. But for conduct risk, what do? There's no amount of capital which can save you. And one incident can turn the reputation of the bank down, as we have seen in the recent past. While we do not have a very codified regulation on conduct, what we are seeing increasingly is the supervisory intervention on conduct. So you see in the supervisory reports a lot more emphasis on governance. In fact, when I was a member of the RBI committee which done the risk-basing supervision model. We focused a lot on capital and other financial parameters, because we thought capital is the one ratio which will mitigate all the risks of the bank. But over the years, we realized that it's governance that matters. So governance and conduct risk has become very critical. Just to show that it's not just the institutional responsibility, it's also the individual responsibility. So countries in fact, I wrote about it, Tamal, yesterday, that the supervisors in other countries have something called a senior managers certification program, where accountability is done on the senior managers, and the regulators actually measure how efficient the senior managers has worked in terms of conducting himself. Even the RBI now, when they put their emphasis on the functioning of the board and management, they look at how well are they governing the bank, how good are those in terms of addressing various risks. So conduct risk to me is going to be increasingly important, and I would easily rate it as my top 3 risks.
Okay, thanks Rabi. Let's talk to Vishwajit, represent Bandhan Bank. Vishwajit, from a private bank's point of view, you are about 8-year-old now. Bandhan started in August 2015, right? So little less than 8 years. Vishwajit used to be, if I'm not mistaken, with ICICI, right? So you have seen the private banking space pretty well, and white hair like me. So tell me about this disruption by the fintechs. That's also a risk, people say. In one of the, in the earlier session, we discussed how a Twitter can actually trigger a run in the bank, how because of technology, people can just in minutes take away all the money, etc. That's one part of it. The other part, of course, the fintech startups. They are also in the space in a big way. So the traditional risk decisioning is being challenged by them. How do you respond to those kind of disruptions? I'm not talking about Bandhan, I'm talking about the entire banking system. But from your experience, is the Indian banking system ready? Private sector bank knows how to respond, or things to be done? What's the roadmap?
Okay.
Yeah.
Am I audible? Okay.
A bit louder.
You will not believing, yesterday only I was having similar discussion with my colleagues.
And I was telling them around 15 years ago, I remember across the world there was a fear that big retails will become and then dislodge the banks from the retail business. So somehow banks adapted itself and move ahead. Today they are the partners actually. Today my previous bank, and I see their Amazon card, they're one of the most successful cards. Coming back to Fintech. Now Fintech has got two parts. Fintech, one is that we heard it time and again about data. Data is very important, but data I think is always an input. I can give you a small example, time permitting. When I was heading a business in my previous organization, it has got your unsecured business loan, which has, the portfolio has become a bit bad, and it was on an auto mode. But since it was, return was quite good, it was going on, there was an auto renewal purpose, and it was going on. And there was a client name which was working fine for last 3 years. It was in Rajasthan. I went and told my RM there, I want to go and meet that customer. I went to meet him and I said, you are one of my good customers. And he said, Babuji ke samay se chal raha hai. Means the account actually belonged to his father who has died 2 years ago. But since it was a auto renewal, it was a dead man's account which we were running on to it. So my own experience is, like when we were small, we used to have a essay which was very popular. It used to be called electricity is a good servant but a bad master. So I think data is a good servant but a bad master. Means data, whatever it is throwing. In one of the panels somebody said, whatever your model is throwing out, please go and see it out. And recent I will give you an example. You know, microfinance got very much affected by the COVID. And one of the reason was a lot of these laborers who goes at other side and others, they either put money or their family were there. So there was a huge churning there. Means people have to move out, they lost their jobs. So the broad model was saying Bihar will be the most probability of default. And we were surprised Bihar was the best performing, it continued to be. So then when we visited there, we found the background of the customer was etc., etc. So what I am trying to tell you is that they will be a very good support to it. It is not actually we as a bank should look them as a competition. It is a co-option. We should take them up. And if I am correct, many of them are being looked at as a sort of digital DSAs nowadays. I think this is the partnership. As I said, almost a decade ago, when this big retail was thought, and now big retail is co-opted. I see they will be co-opted because they will be, and to be honest with you, bankers get a lot of reasons to co-opt many of the units, like today we are talking about Fintech, because overall the, what I will say, compliance cost of doing a banking is much more and tougher than doing anything. Rightfully so, because it is on the bank's depositors' money, it is working on it. So my own reading which I see is that going forward, it will be co-opted as a partner.
We'll hear Shreya and we'll hear SAS also on that. But before that, the two bankers, one banker clearly, UCO Bank is public sector bank, and IDBI is a sort of hybrid. I think technically you are a private bank, right? Okay, so between the two, I think let's Om Prakash comes first. So tell us at this point of time, what are the risks are you seeing, not in terms of IDBI, but IDBI has a checkered history, financial institution, now then it's got into through reverse merger becoming a bank, and then it was, I would not say collapsing, but it has a capital issue which then LIC chipped in. So you have a very checkered history when it comes to risk. Yeah. So from the entire history of Reserve Bank, IDBI, what are the lessons that you have learned in risk management, and what's the ground now?
Hi, good evening. Hope I'm audible to all. So basically, the risk management, if we see the way time traverses and we are moving more towards the digital, Of course, the risk is also coming from the channels, right? Digital channels. So there are, if you see the transactions, right? So there is a point of source and there's a customer who is initiating the transaction. And then there are the systems, and then, there are the employees. So there are the exogenous as well as endogenous, both kinds of the risk. Now, if you see the more and more we are going toward digital, the risk which is emanating is of course going to be more from the digital channel side, and which requires us to understand the customer persona. It's kind of behavior analytics of the customer as well, right? That what is his digital identity? Digital identity means that can we define a customer with his mobile, with his kind of activity, with his kind of place of transaction, with a kind of devices normally, and with kind of transaction he does, right? So that's the one kind of persona which we can define. This is the customer. And when it comes to the system, and then there are the system, there are the, of course, there are transactions. Now the employees, like we are talking more about the conduct, right? We are talking more about the behavioral analytics of the employees also, that's also very paramount. The reason behind this, the work from anywhere. See the kind of the factors, the kind of dimensions of the employees which are changing, right? It's not only inside the corporate, right? They are work from anywhere, working from some, home, working from some other place. And also we are talking about the fintechs. We are also talking about the extended, partners, like who are working on behalf of us with the RBI saying that, okay, we are the owner for whatever you delegate, right? So this also implies that do we know the employee behavior? That we cannot define it as part of conduct. We cannot define in what and all that. Of course, that's going to set the basic rules. But what important is, can we identify the employee behavior? And can we know what is the anomaly if the employee deviates actually? Now, one of the most important thing is that how fast I can detect it. First thing is that how I can prevent this, right? So there are the systems which are going to have a controls which are going to prevent it. But of course, there are always, some employer somewhere, the loopholes, something will happen. Then whether the models, can they detect the anomaly and give the early warning signals? Now, what is more important over here is we all talked about the data. The data is very important. The data, the real-time ingestion of the data we are talking about. The data in real-time ingestion, which is a bigger challenge. More and more we grow, more and more we scale, we all talked about, right? The getting the right data at the real time is the tougher challenge, right? The more we delay the data ingestion, I think we lose the decision. Whatever the model we get, right? If the quality is not good, if the time of the ingestion is not good, some of the materialistic significant data is lost out, then the model and risk will not be appropriate. So we will all talk about the models are not working fine. And that gives some kind of, less belief on the model and people doing more onto the rule-based system. So basically, this is the whole kind of risk we are talking about, the enterprise risk and then the customer-related risk, the digital risk and all this, which we are...
Thank you, Mr. Seth. So just you heard him, even the behavior could be a risk. So on the one hand, you are talking about artificial intelligence and machine learning. On the other hand, how even the behavior could be a risk. Incidentally, Citibank, many years back, when they advertised for, I'm again talking about not Citi in India, but in New York, advertised for certain middle-level executives, they asked for also, along with all the other qualifications, it became a big headline on Financial Times, sense of humor. Yeah. Whether you have a sense of humor, that's the thing and all. So, Dilip Mirda, among the bankers, you worked in Singapore, you worked in Hong Kong, and now you are general manager mid-corporate, but you did manage risk, you did manage compliance. So you had a 360-degree view of risks and how the bank manages. Tell us if this house gives you the mandate to give certain ideas to your board, how to better manage risk. your board meaning not UCO Bank board, any bank board, what are the things that you would recommend?
Good evening to all. The risk management, there are various aspects of risk management, but primarily which I concentrate basically on the credit risk aspect, because deployment of credit is a very vital issue, and the risk is a risk adjusted return. What we get out of the credit is very important, because the moment I am considering the return available into the credit deployment, there ultimately all the risk is being inbuilt into that, because all liquidity risk is covered, all my fraud risk is covered, my cost of capital risk is covered. Then also recently discussed about the ECL, the expected credit loss, the probability of default, loss given default or EAD, that part is also being covered. So all the major risk areas are being covered while risk-based pricing is calculated. And under the CAPM model, the risk adjusted return, when it is being calculated, the hurdle rate, that is the primary area. And that's why we are focusing, and we have taken a view, that any loan pricing, before sanctioning any loan, that should be cleared by the risk vertical, and that should be cleared from the RAROC point of view, risk adjusted return point of view. That is one area. Second area, another area is the fraud risk management area. The fraud risk, it is now, of course, it is now under control. There is one technology called fraud risk management solution. And that is most of the banks, it is under process of implementation. And this fraud risk management solution will give you the trigger. And the real-time basis fraud risk management, if any fraud incident happen, the management should know, the fraud risk cell, the fraud risk team should know that fraud has happened, and the necessary preventive measure, necessary mitigation, they should also consider and they should take up. So that fraud risk management also area, our board is also equally concerned along with the regulator. Fraud risk management area, whether it is internal fraud or it is external fraud, fraud created by the cybercrime cell, fraud created by the fraudsters, fraud created due to the digital banking, and from ransomware or hacking. So all these things, or the cloning of the check or cloning of ATM, all these fraud prone areas are very serious issue. And recently the banks, previously it was telling that the bank is going for more and more gold loan, being a secured loan. From the NBFC, it is shifted to the other private sector and in the public sector bank. And very lucrative in the sense that provisioning requirement being low. But this gold loan is also a fraud prone area. The moment it is a fake gold is detected, or gold is not being kept in the safe properly, or gold is being theft, and all these, and EPT, EP, whatever the revenue we are generating, net interest income out of gold loan portfolio, and if one big ticket size gold loan goes bad, then the entire NII out of gold loan will be washed out. So that is a matter of concern. So now these two areas. Apart from this, the market risk, the IRBB approach which they are discussing, and because of the market risk in the last few quarters, we have seen most of the banks, they are experiencing mark-to-market provisioning, and as a result, their profit is also being reduced, and profit got affected. So that is the area. The liquidity risk is also another area. The cost of fund depends on the liquidity management as well as on the deposit side. They go for the low-cost deposit to maintain the cost of fund, to manage the cost of fund, so that the NIM and NII can be restored. Okay. So all these are the major area which I would like to advise to the board to take care.
Thanks. Very, very extensive note to the board, Dilip. Very, very extensive. So now I'm left with Abdullah and Shreya. So I have a gender bias. You'll have the last word. Before that, Abdullah, your designation says Head of Credit Risk Modeling and Machine Learning. So tell us about the use of AI and ML in risk management.
Banks were exploring options how to leverage on AI ML technology in the credit decisioning and the credit risk modeling for the last, I guess, 5 years at least. So banks were trying to do RPA, which is not really AI ML, but still they were trying to utilize advanced machine learning techniques to do feature creation, feature selection. Then we're trying to create A, B, C scorecards using these technologies, but based again mostly on the traditional data. So what recently picked up globally, I would say, is utilizing open banking data or data coming from financial data aggregators, where you are able to connect to external data sources, which would be other banks, get transactional information about what are the transactions on the credit cards, on the checking accounts, on the savings account for the last 1 year, 2 years, and basically see what is the behavior of the consumer, understand what kind of transactions, when happens, where a person prefers to spend money, or how fast he is spending his salary when it comes into his checking account. So it's a vast variety of data which can allow us to underwrite customers better, and also use for collections and for early warnings. I guess one of the challenges here is since there is a shift in the generation and also in a consumer expectation, how financial services are provided. Basically now people are waiting to get a decision on their credit cards in 1 minute, in 5 minutes maximum. And that's where you need to go and tap into this data, which is pretty big. I know, let's say 100,000 transactions for the last 2 years. You need to be able to do aggregation of this data to understand what are the average spendings, what are the other patterns, what is, I don't know, slope of spending. You might also want to do, for example, named entity recognition to understand where person typically shops. Is it a McDonald's or is it a fine dining and things like that? And this needs to happen in real time because you need to make a decision in 1 minute or in a maximum 5 minutes. So, and that's where comes the importance. A lot of banks are trying to do this, and they're relatively successful when they're doing this as at the design stage, using different tools like open source, Python, and so on. But then when it comes to the deployment, that's where they run into the issues, because it's separate tools which are not really integrated with each other and might be not very optimized from the governance and auditability perspective for the process. And that's where, for example, SAS plays a lot, where we offer the integrated capabilities for both data management and the decisioning. And you can do all of these aggregations and the calculations in real time and make real-time decisions.
Thanks, Abdullah. I'll come back to you. I'll ask now Shreya. Before that, before you start, I'll just tell the audience if you have any question, because after she speaks, we'll take 1 or 2 questions from you, and then we have 1 minute from each of them on one particular, each of them will be different issues and all. So just get the microphone ready and keep your question ready to anyone if you want it. Shreya, just taking this forward about using AI and ML, what are the, how do you, the ethical and regulatory challenges using this, how do you tackle that?
So perhaps, Tamal, the biggest regulatory challenge when it comes to AI and ML models is how do we ensure fairness of those models?
Exactly, that's what I'm saying. Yeah.
So how do we, and ensuring fairness becomes very important, mainly because the inherent data that goes into these models suffers from a lot of different biases. And a lot of times these are judgmental biases which has crept into the data. And
Can you just explain a bit when do you say judgmental biases?
Okay,
meaning?
so say for example, I'll give you an example. So recently we were doing an exercise with one of our clients where we started seeing a very peculiar trend. So in Indian banking sector, typically the gems and jewelry sector is considered to be a bit risky in nature. And this bank was actually doing very low number of gems and jewelry cases, but the ones that they were onboarding were really very safe customers. So when we had put this data into the model, what the model threw up is that gems and jewelry is perhaps the least riskier of all the industrial segments that we can consider. So this is a real life case where if we just go blindly basis that data without that human touch, we do not get actionable insights. If we are taking the insights just from what the model is throwing up, it might be a very different direction that we will end up taking. So that's what I mean by a judgmental bias, which gets in. And perhaps the next important point for an AI model is the interpretability. Most of the times, the AI models that we build are kind of black box models. So what happens is, what are the ways in which various data points are interacting? What are the ways in which various factors are interacting? It becomes very difficult to gauge. And perhaps that's where I think there is a lot of scope, which when it comes to improving the interpretability of the model or ensuring the fairness, that's where the entire focus on model, doing ongoing monitoring of this model or building challenger models for some of these AI/ML models becomes extremely important. And that's something what I think most of the banks which are planning to adopt AI/ML models need to do, have a very strong governance around these models and constantly keep on monitoring what are the kind of outputs that the model are throwing.
Okay. Yes, sir. Can this gentleman have the mic, please? And anybody else? And then we'll have a quick second and last round. Yeah. Just introduce yourself and brief question, no commentary. Yeah. Phone. This is not working, I guess.
Hello.
Yeah.
Yeah, my name is Gopal Tripathi. I head Treasury and Capital Market for Janai Small Finance Bank. My question is regarding this conduct risk, which is being paramount for and which is superseding all the other risk in terms of how the bank will appropriate for that. So the question is that how do you quantify the intangible risk like conduct risk when you have to control the tangible like risk like market risk, credit risk and all other risks, because they are tangible, and conduct risk is a intangible component. So how do you quantify that? That is my question.
Over to Ravi, sir.
Why do you want to quantify it?
Unless you quantify, you will not be able to know the quantum you require.
You know that advertisement, no? Something costs something for others are priceless. Yeah, a lot of things are priceless, but others you have MasterCard. So similarly, I don't think we have come to a stage we can quantify conduct risk, but it has to be inbuilt. In a sense, I would say there's zero tolerance for any sort of conduct mishaps. You just can't afford it. So there's no model to say, okay, I put X number and there's an AI which brings out. There are ways of predictive behavior which you can do it, but to quantify it in a rational manner where you can put a capital, not possible. But there are ways. I know one large global company in the Treasury in New York. So you're a treasurer, so you should be a bit worried about this. So there is a large multinational company where the Treasury guys, all the dealers have Fitbits, right? What do you call it? Fitbits, right? And those are linked to the compliance guys' computers. So the compliance guys see that, and whenever the pulse rate has gone up high, they pull out those rates to examine. So there are a lot of sophisticated ways of measuring that, but I think in terms of your risk matrix, you can put in things like what are the behavioral issues which has happened, what is the predictive behavior which has happened, what are the breaches which has happened, and build it in part of your operational risk framework. But there's no scientific way of quantifying it. All I say to clients whom I advise is zero tolerance. You just have to get this right from the level down. Unless the front line gets that right, you just can't run from a board level saying, conduct is everything. That won't happen.
Thanks to both of you for the brilliant question and equally brilliant answer. Anybody else want to ask any question? Or we can move ahead? No? All are feeling hungry and thirsty. So, yeah. So we'll quickly, 1 minute each probably, or 1.5 maximum. Abdullah, will start with you. You spoke about AI and ML. Now, India, when it comes to technology, in the payment space, we are the probably the best, better than most of the developed markets. But the use of AI and ML in use of the customer behavior and all, what you technically call it deep tech, I think. There, I think we are not there as yet. Do you, through your lens, also see Indian market that way? We have miles to go in that deep tech area, which we have already covered in the payment space?
Well,
or you are saying really banks are doing AI and ML and checking the customer's behavior, everything is fine?
Well, clearly there is a room for improvement in all of the markets. So
I know they are your potential customer. You can't afford to make them upset, but still, don't be diplomatic.
Let's say, to an extent, let's say US market is also developed, and there are countries in European markets which are developed in the payment space. But there is still payments risk, which happens. There is a payments fraud, and new technologies are coming in, and there is an opportunity for improvement. And one of the examples would be, I'm sure everyone heard about ChatGPT and the large language models. And there is a decent amount of research which came out recently that using large language models, when you look at the transactions and all of the patterns and transaction descriptions for the payments, allows you to do a clusterization of these transactions and identify potential fraud patterns or payment risk better than any existing fraud models, which are typically built using logistic regressions because of the regulation. So there is clearly a lot of room for improvement from both technology perspective, what kind of models you are using, and then from a governance perspective.
Thanks. Sriya, just where you ended, if you can extend a bit, how this Indian banks are, you spoke about, the subjectivity or bias, etc. So how are you advising the Indian banks to change the approach?
So in terms...
No marketing pitch, just...
Okay. Of course, Tamal. So I guess it's a three-pronged approach that banks need to take. Firstly and foremost, a strong governance needs to be set around all these models that we are dealing with. As it is, like, it can be an extension of the typical models that you have in the banking space, be it for credit underwriting or for ECL computations. But for this AI ML piece, you need to have a much more stronger governance. Secondly, will be a regular monitoring or an ongoing monitoring that we call for these models. So typically, these models have a tendency to change the parameter values, the calibration at a very quick instant, because every time they are ingesting more data, and as a result of which these models are some of these models are self-learning models, and that's why recalibration happens at a much higher frequency. So that's why an ongoing monitoring is of a key essence, just to understand that whether the model is throwing up the results as expected or not. And thirdly, I would say is having a clear-cut communication between the model developers and the model users. And that's where we see a lot of gap happening. The requirements that the model users who will be using it either for a credit decisioning or for any kind of analytics, and the way the data scientists are developing the models, somewhere that scope alignment doesn't happen.
Excellent, the gaps that you're talking about. You spoke about three-pronged approach, so that reminds me, Ravi sir, you spoke that conduct risk is one of the three risks. Which are the other two that you are alluding or talking about? You mentioned that word. This is the one of the three key
Thanks, Ray. Pitching on governance, so I'll have more clients. I'll have more clients on governance side. Sure. Okay, I would say, I said it's three.
One of the three. Yeah.
Conduct is, of course...
So which are the other two?
Yeah, other two is, of course, the credit risk, which will continue. We'll have to monitor that very closely. The third is the whole, I would say, part of the operational risk, but cyber security, data privacy, the whole lot of information technology risk. I think that's a risk which we are getting highlighted now, and that needs to be addressed.
Okay. I'll go to IDBI, Mr. Seth. Just tell us, do you see this is a risk? Because in some class of bankers, I'm not going to identify them, not to offend them and all. There's a sort of hard mentality we see. Meaning basically one bank is doing and then every bank else, irrespective of your balance sheet size, irrespective of whatever it is. State Bank of India has done this, so I have to be there and all. So that has been the traditional history there. And then if you see that last 5-6 years post this AQR etc. change, everybody is into retail. If you look at the balance sheet of every bank, including yours will be 70% retail, I guess, IDBI.
Yeah.
There are banks which is 55%, 60% retail and all. 5 years back, they were just reverse and all.
Yeah.
So are these actually banks well equipped to handle this? Or you think we are actually sowing the seeds of risks? It's just basically to go with the tide, and when the tide goes away, who is naked we'll see.
Basically, I believe that the fraud risk you take, or you take cyber risk or whatever, this is difficult for a single bank to.
No, I'm talking about the entire approach.
Okay.
From a 360 degree, you are saying from credit, from corporate, now we have gone into all retail.
Okay.
Now, do I have the right kind of risk management, underwriting, even keeping the mortgage papers? I'm just telling you my real life, one particular bank I found out, they don't have even the real storage for mortgage paper. And they're a very aggressive player in the mortgage market.
Yeah,
so I'm saying, do you see risk there?
In the
system I'm talking about. No, just the pendulum swing from one to other end.
Yeah.
Without putting your house in order. Is that a big risk for Indian banking system?
Yes, that is. Let me admit that is a big risk. If there is a shift from one side to other side, and then accordingly, the risk vectors changes, right? And the risk vectors changes, and accordingly the system and the risk monitoring, everything need to be recalibrated to cater to the risk emanating from the other side actually. So of course we are geared up because we have a good risk monitoring systems, from the retail side as well we have, right? So as I spoke about that,
no, I'm not talking about your bank. General, I'm saying the trend, trend itself. You see the risk there in the trend.
Yes.
Okay. We are left with two more persons, Mr. Mirda and Vishwajit. So Mirda Sahab, I'll keep you the last person. Vishwajit, tell you are a very different kind of entity. You started with a microfinance and then you are a full-fledged bank and all. So your perception of risk will be different from the others and all. Can you just tell us more, like what are the extra thing that you do to be aware of all the risks? Because you have right from political risks in different states, budget, loan waiver, etc. Apart, then the flood, then the drought, etc., etc. The more unsecured loan you have and the more granular loan you have, on the one hand you may feel very secure that look, one fellow will not make 1,000 crore whole, but if one geography goes for this, one state goes for this kind of, I'm talking the political risk. So from there, from your part, again not for Bandhan, but this kind of entities which have substantial or much exposure to the unsecured loan, what would be the lessons they should learn?
Let me put it like that, as
Sure.
you said, if I extend it 2015, actually huge chunk of the microfinance segment was brought under the banking through Bandhan and then through the SFBs. So I will take it from that angle. Some of the things, as you said, concentration risk, the way we look at more from geography angle, which is not there in case of in my previous organization and others, where we look into more from the segments and others. Second issue which I saw is that banking sector has evolved a lot, but because specifically the industry related reports, etc., which you find, which you will not actually put it into the microfinance business. Let me give you, on the roadside hotels are taken as a hotel there. So those hotels nowhere get covered under any of the industry things, which is broadly at a certain level of things. That is true of when we talk about textile industry or others. So here, as an organization, the system support that you get directly from in the banking sector, where you can just put it in a straightforward way. Here you have to go visit the field and then see and build up your own model. As sometime we discussed in one of the panels, it was said about India is very vast. Actually, each district is so different here. The way I will say ready-made garments is formed in one side of Calcutta and the other side of the Calcutta, from where that supply is coming and from where it going is so different. So this is a thing where, again I am coming back, while we can always talk about data and all those things, this is where you have to be there in the field to do that. So while many places for economy of scale, you have to go for automation, centralization and other, here that risk run there. And third one is that from 2015, broadly if you see, there is a RBI last year has come up with a clear-cut guidelines about the microfinance for banks. Before that, there was a, in a way, I will say dichotomy between the way that segment was there. Means it has to, there is a, I will say asymmetry between the regulatory requirements and the way that business used to work, which over last 5-6 years has got aligned, I will say, to the much more.
So going beyond, of course, AI and ML is very important, but beyond that also ground reality, that's what I'm saying. Mr. Mirza, you have the toughest task. Whatever we have not discussed, left out, you please raise and conclude. And just pointed to you, it's not exactly risk, but the perception is this, the best in banking is, oh, I mean, we have seen from now on, you will not be, the ride will not be as smooth as, because on the one, the kind of, the entire deposits now getting repriced, so the NIM will be under pressure. You are enjoying pretty, we are going through the NIM, all banks, every quarter is going NIM up and up and up, because as in one of the discussions, Deputy Governor, ex-Deputy Governor is talking about ECL, that's, sorry, the external benchmark, EBR related. So all the loans have gone up by 250 basis points automatically, which are linked to repo. If it's 364 day Treasury bill linked, which has gone even higher. But your deposits, when you are raising, it's only incremental deposits. Actually, so from June onwards, your bulk of the deposits will be repriced so that the NIM will be under pressure. B, the recovery was playing a very critical role in boosting your profit. Recovery also been done through. And C, correct me if I'm wrong, we are seeing some kind of slippages in, particularly in retail segment. SMA and SMA1, that's beyond 30 days and beyond 60 days. Banks are not openly saying it, but it has already started. So which means the banks would need to start provisioning again, which was not doing. These are the new risks that you see?
Rightly you have pointed out.
Very quickly, sir, not more than 1.5 minutes.
No, 1 minute not possible. 2 minutes. This deposit side, actually true, the moment the repo is increasing, we are increasing the rate, MCLR, and immediately it is getting affected. But the liability side is getting matured, and time, the accrued interest and payment, that liability takes time. So immediately that liability burden is not there. So that's why NIM advantage we are getting. But now the June quarter, September quarter, we will not get that advantage. At the same time, the market, the yield being low, the mark-to-market provision can get reversed, and in that case, bank can get treasury profit will be there, where the treasury profit was not available during the last quarter. So that also it will contribute. And on the other hand, most of the banks are now going for the retail segment, and you have observed that the slippage is being very low across the banking industry, and the slippage is being very low. The NPA percentage is being very low, provisioning requirement being very low, that will get the advantage. On the other hand, the recovery point of view, the IBC code, the NCLT, or whatever the written up accounts are there in the bank's book, those accounts, most of the cases, the soft NPA, those NPAs are recovered where 100% provisions were made or it was written off. Now whatever the remaining NPA or the written off portfolio is lying, there the recovery is quite tough, and the windfall gain is not there, unlike the NCLT big accounts recovery which you got, which you could not expect, but that helped our balance sheet in profit and loss account. That may not be coming in the coming quarter or coming year. On the other hand, is the credit monitoring system being strengthened, EWS early warning system being in place, fraud risk management solution being in place. Bank has gone for digital banking because of under the EASE program. That EASE requirement, EASE EASE requirement. Now the total system, the ministry, the DFS, they want that system should be digitalized. So in that case, cost of manpower will not be that much. So overall, per employee business, per employee productivity would increase. So on the other hand, the ECL provisioning part is threatening. All the banking system, so far I know, the Indian accounting system, we are publishing our balance sheet profit and loss account. Side by side, IFRS system also, they are preparing the balance sheet and profit and loss account. Well, of course, that is not being published, and that is just for return sake to be submitted to RBI. And there we are observing that our capital requirement is much more. Profit is quite less in the under new IFRS regime. So if that part comes into, that part is implemented, then profitability would get hit. But the capital adequacy ratio front, most of the banks are quite comfortable in the capital adequacy requirement in 11.5%, which is required regulatory capital. Most of the banks are having 13%, 14, 15% capital requirement. So the credit deployment opportunity is there, provided the liquidity front is comfortable. Okay. So this is the overall picture of that.
Yeah, thanks Dilip for giving the overall picture. So that brings us to the end, as we started saying that banking is a risky business. Risk is the fulcrum of banking, and that's why we must have noticed that Reserve Bank of India, when it asks for banking license, it's not the highest bidder it goes to. For anything else, if it's a coal mine, it's a telecom, anything else, the highest bidder get the license. But for banking, it's either 500 crore or 1000 crore, whatever it is. So you need to be fit and proper, because this is the only business where both the raw material and finished product, both is money. And it's your money and my money. So this gentleman handle, this 4 gentlemen handle this, other 3 of them handle your money, my money. This is the only business, again I'm repeating, both the raw material and the finished product is money, which is why it's all the more risky. And as long as that is there, both Anstoni and Shreya and Abdullah, your business will continue to grow. Okay? So give them a big hand. Thank you.
Many thanks for the panel for this high quality discussion. And in some sense, this panel was closest to the brand of today's event, which is risk and banking resilience, because we thought only there is credit risk, but we heard at least 7 types of other risks, conduct risk, data risk, compliance risk, work from home risk, digital risk, behavior risk, fraud risk, judgmental risk, concentration risk, geographical risk, segmental risk. So I'm sure this audience is enlightened enough for that. Thanks so much. Thank you so much. Now may I now invite Mr. Radhakrishnan B. of SAS and Mr. Kailash Prabhu of EY to give the closing remarks from our partners' perspective. Yeah, thank you.
Good evening, everyone. Thank you for the time. I know we extended, but it was very insightful and exciting to have everybody's views. Quick introduction about me. I'm Kailash Prabhu. I run the Risk and Regulatory Technology practice for EY India. The reason we have this Risk and Regulatory Technology practice is because we think and we understand very clearly that the role of CRO's function is going to emerge and it's going to be huge. There's a clear expectation that the CROs need to think globally, understand the global events, impact on the banks locally, as well as the local regulations and the whole pace of digitization, right? With all those aspects, it is very important for the CRO's function to be more agile and be more transformative. And this is where we think technology will play a big role. At this point in time, the decision needs to be quick, decision needs to be as close as accurate as possible, and it kind of need to help you to unearth the unknown unknowns, right? And when that is needed, if CRO's function take time in analyzing the results, running Excel files, it's going to be like a toll gate in the business transformation and business growth, right? Will not be a transformative function. So to build a better risk management function, the need of the hour definitely is technology that can be applied at scale, helps you to innovate very quickly, of course with humans at center, with experts at center. So that's been our focus. Working back with SAS, as we speak currently, within the domestic banks, we are running around 15 plus risk technology projects with around 70 plus folks closely between EY and SAS, and we are hoping to make the risk management function a better function. Right. Thank you for all your time.
Thanks, Kailash. I was just hoping not to hear one word through this conference because of all the conferences what I attended recently. I have a hangover of a word called ChatGPT, but just when I thought this I will not hear it, my own colleague Abdullo kind of spelled it out actually. Okay, so as we near the conclusion of this risk summit, on behalf of SAS, my sincere thanks to each one of you for your active participation. It kind of got delayed, but thanks for your active participation, insightful contributions and commitment to address pressing challenges what we face today. Over the course of these enlightening discussions and engaging sessions, we had explored wide range of risk. I think he mentioned the number of kind of risk, much beyond what typically banks look at. But there was extensively these risks that were discussed around credit, liquidity, and interest rate risk. The experts have shared, I think, something which was used heavily in today's discussion was around interdependence, which could lead to something what we call it as contagion. Explained their far-reaching implications and delved into innovative strategies and solutions to mitigate and manage them effectively. I would like to extend appreciation to the business standard team who have worked tirelessly to bring all the leaders across multiple banks under one room. Their meticulous planning and seamless execution has ensured this event has been a resounding success. And thanks to our knowledge partner EY for sharing their expert views in each of the domains. Thank you once again for the speakers, panel experts and delegates for your active participation. I look forward for your continuous collaboration, and that's what there was a mention of business, okay, to create positive impact together. Finally, one small request. I would request to focus your mobile phone cameras on the QR code here so that you can provide your feedback so that we can improve upon the quality of the risk summit. Please do reach out to the registration desk to pick up your delegate kits actually. Thanks a lot once again. Thanks everyone for this wonderful participation, make it successful. Thank you.
Thank you, ladies and gentlemen. That brings us to an end of today's proceedings. May I invite everyone to please join us for dinner and cocktails. Thank you. Thank you once again.